1. Understanding the intrinsic value of business. 1.1 Defining intrinsic value. Intrinsic value is a fundamental concept in the world of business and finance. It refers to the true worth or underlying value of a business, asset, or investment, independent of its market price. It represents the value that an asset or business possesses based on its inherent characteristics, rather than its perceived value in the market. At its core, intrinsic value is determined by the future cash flows that an asset or business is expected to generate. It takes into account various factors such as the company's financial performance, growth prospects, competitive advantage, and risk profile. Intrinsic value is often considered as the fair value of an investment, providing a benchmark against which market prices can be compared. The concept of intrinsic value is closely related to the concept of value investing, which focuses on identifying undervalued assets or businesses that have a higher intrinsic value than their market price suggests. Value investors believe that over time, the market will recognize and reflect the true worth of these assets, leading to potential profits. Intrinsic value can be calculated using different methods, such as discounted cash flow (DCF) analysis, relative valuation, and asset-based valuation approaches. These methods involve analyzing financial statements, assessing industry and market conditions, and making assumptions about future cash flows and growth rates. It is important to note that intrinsic value is subjective and can vary depending on the perspective of the investor or analyst. Different individuals may have different opinions on the future prospects and risks associated with a particular asset or business, leading to variations in the calculated intrinsic value. Moreover, intrinsic value is not a static concept. It can change over time as new information becomes available or as market conditions evolve. Therefore, it is crucial for investors and analysts to regularly reassess and update their calculations of intrinsic value to make informed investment decisions. Intrinsic value is not limited to publicly traded companies or financial assets. It can also be applied to private businesses, real estate properties, and other tangible or intangible assets. In these cases, determining the intrinsic value may involve additional considerations, such as the value of the underlying assets, the potential for future growth, and the market demand for similar assets. Understanding and accurately assessing intrinsic value is essential for making sound investment decisions. By identifying assets or businesses that are trading below their intrinsic value, investors can potentially capitalize on market inefficiencies and generate long-term returns. On the other hand, overpaying for an asset that is trading above its intrinsic value can lead to poor investment outcomes. In conclusion, intrinsic value represents the true worth of an asset or business based on its underlying characteristics and future cash flows. It serves as a benchmark for assessing the fair value of investments and plays a crucial role in investment decision-making. By understanding and analyzing intrinsic value, investors can make informed choices and potentially achieve superior investment returns. 1.2 Factors affecting intrinsic value. Intrinsic value is a fundamental concept in business that represents the true worth or underlying value of a company or an investment. It is the value that is derived from the company's assets, earnings potential, growth prospects, and other factors that contribute to its long-term success. Understanding the factors that affect intrinsic value is crucial for investors and business owners alike, as it helps in making informed decisions about buying, selling, or holding onto investments. There are several key factors that can significantly impact the intrinsic value of a business. These factors can be broadly categorized into internal and external factors. Internal factors are those that are within the control of the company, while external factors are influenced by the broader economic, industry, and market conditions. Let's explore some of the major factors that affect intrinsic value. 1.2.1 Financial performance and stability. The financial performance and stability of a company play a vital role in determining its intrinsic value. Factors such as revenue growth, profitability, cash flow generation, and debt levels are critical indicators of a company's financial health. A company with consistent revenue growth, healthy profit margins, and strong cash flow is likely to have a higher intrinsic value compared to a company with declining revenues, low profitability, and high debt burden. 1.2.2 Industry and market conditions. The industry in which a company operates and the overall market conditions can significantly impact its intrinsic value. Industries that are growing rapidly and have favorable long-term prospects tend to have higher intrinsic values. On the other hand, industries facing challenges or undergoing disruption may have lower intrinsic values. Similarly, market conditions such as interest rates, inflation, and investor sentiment can influence the perceived value of a company and its intrinsic value. 1.2.3 Competitive position and market share. The competitive position of a company and its market share are crucial factors affecting intrinsic value. Companies that have a strong competitive advantage, unique products or services, and a significant market share are likely to have higher intrinsic values. A strong market position allows a company to generate higher profits, attract more customers, and maintain pricing power, all of which contribute to its intrinsic value. 1.2.4 Management quality and leadership. The quality of management and leadership within a company can have a profound impact on its intrinsic value. Competent and visionary leadership that effectively manages the company's resources, makes strategic decisions, and adapts to changing market conditions can enhance the company's intrinsic value. Conversely, poor management decisions, lack of transparency, or ethical issues can erode the intrinsic value of a company. 1.2.5 Growth potential and innovation. The growth potential and ability to innovate are critical factors that affect the intrinsic value of a business. Companies that have a clear growth strategy, invest in research and development, and continuously innovate are more likely to have higher intrinsic values. The ability to adapt to technological advancements, changing consumer preferences, and emerging market trends can significantly enhance a company's intrinsic value. 1.2.6 Regulatory and legal environment. The regulatory and legal environment in which a company operates can impact its intrinsic value. Companies operating in highly regulated industries or facing legal challenges may have lower intrinsic values due to the potential risks and uncertainties associated with compliance and litigation. On the other hand, companies operating in favorable regulatory environments or benefiting from supportive government policies may have higher intrinsic values. 1.2.7 Macroeconomic factors. Macroeconomic factors such as economic growth, inflation, interest rates, and currency fluctuations can influence the intrinsic value of a business. A strong economy with low inflation and favorable interest rates generally supports higher intrinsic values. Conversely, economic downturns, high inflation, or volatile currency markets can negatively impact a company's intrinsic value. 1.2.8 Social and environmental factors. In recent years, social and environmental factors have gained prominence in determining the intrinsic value of a business. Factors such as corporate social responsibility, sustainability practices, and environmental impact can influence the perception of a company's value by investors, customers, and other stakeholders. Companies that demonstrate a commitment to social and environmental responsibility may have higher intrinsic values due to their positive reputation and long-term sustainability. In conclusion, intrinsic value is influenced by a wide range of factors, both internal and external to the company. Financial performance, industry conditions, competitive position, management quality, growth potential, regulatory environment, macroeconomic factors, and social environmental factors all play a significant role in determining the intrinsic value of a business. Understanding these factors and their impact on intrinsic value is essential for making informed investment decisions and assessing the long-term prospects of a company. 1.3 Methods of calculating intrinsic value. Calculating the intrinsic value of a business is a crucial step in understanding its true worth. It involves assessing the underlying factors that contribute to the value of a business beyond its market price. By determining the intrinsic value, investors and analysts can make informed decisions about whether a business is overvalued or undervalued in the market. There are several methods used to calculate the intrinsic value of a business. Each method has its own set of assumptions and variables, and the choice of method depends on the nature of the business and the availability of relevant data. In this section, we will explore some of the commonly used methods for calculating intrinsic value. 1.3.1 Discounted cash flow (DCF) analysis. One of the most widely used methods for calculating intrinsic value is the discounted cash flow (DCF) analysis. This method estimates the present value of a business by discounting its expected future cash flows to their present value. The DCF analysis takes into account the time value of money, which means that future cash flows are worth less than their face value due to the opportunity cost of investing in other assets. To perform a DCF analysis, one needs to forecast the future cash flows of the business and determine an appropriate discount rate. The discount rate is typically the weighted average cost of capital (WACC), which represents the cost of financing the business through a combination of debt and equity. By discounting the projected cash flows back to the present, the DCF analysis provides an estimate of the intrinsic value of the business. 1.3.2 Relative valuation methods. Another approach to calculating intrinsic value is through relative valuation methods. These methods compare the business to similar companies in the same industry or market and assess its value based on relative metrics such as price to earnings (PE) ratio, price to sales (PS) ratio, or price to book (PB) ratio. The idea behind relative valuation is that businesses in the same industry tend to have similar valuation multiples. By comparing a business's valuation multiples to those of its peers, analysts can determine whether the business is overvalued or undervalued relative to its industry. However, it is important to consider the specific characteristics and fundamentals of the business being analyzed, as well as any unique factors that may affect its valuation. 1.3.3 Asset-based valuation approaches. Asset-based valuation approaches estimate the intrinsic value of a business by assessing its net assets. This method is particularly useful for businesses with significant tangible assets, such as real estate or manufacturing companies. Asset-based valuation approaches include methods like book value, liquidation value, and replacement cost. The book value method calculates the intrinsic value by subtracting the total liabilities of the business from its total assets. This approach provides a conservative estimate of the business's value, as it does not take into account any intangible assets or future earnings potential. The liquidation value method estimates the value of a business if its assets were to be sold off and its liabilities paid off. This method is often used in distressed situations or when valuing businesses with significant tangible assets that can be easily liquidated. The replacement cost method calculates the value of a business by estimating the cost of replacing its assets with similar assets at current market prices. This approach is useful for businesses with unique or specialized assets that may not have a readily available market price. 1.3.4 Real Options Analysis. Real options analysis is a method used to assess the value of managerial flexibility and the potential for future growth opportunities. It recognizes that businesses have the option to make strategic decisions that can create value over time. Real options analysis applies option pricing models, such as the Black-Scholes model, to estimate the value of these strategic options. By considering the potential upside and downside of different strategic choices, real options analysis provides a more comprehensive view of a business's intrinsic value. This method is particularly relevant for businesses operating in industries with high uncertainty and volatility, where the ability to adapt and seize opportunities is crucial. In conclusion, calculating the intrinsic value of a business requires a thorough analysis of its underlying factors and future prospects. Methods such as discounted cash flow analysis, relative valuation, asset-based valuation, and real options analysis provide different perspectives on a business's intrinsic value. It is important to consider the strengths and limitations of each method and use them in combination to arrive at a comprehensive assessment of a business's true worth. 1.4 Importance of intrinsic value in business decision-making. Intrinsic value plays a crucial role in business decision-making as it provides a fundamental framework for evaluating the worth of a business or investment. It serves as a guiding principle for entrepreneurs, investors, and managers in making informed decisions that align with the long-term goals and objectives of the organization. 1.4.1 Understanding intrinsic value. Before delving into the importance of intrinsic value in business decision-making, it is essential to have a clear understanding of what intrinsic value represents. Intrinsic value refers to the true worth or value of an asset, company, or investment based on its underlying characteristics, potential future cash flows, and other relevant factors. It is distinct from the market price, which may fluctuate due to various external factors such as market sentiment, investor behavior, and economic conditions. 1.4.2 Foundation for decision-making. The importance of intrinsic value lies in its ability to provide a solid foundation for decision-making. By focusing on the intrinsic value of a business, decision-makers can gain a deeper understanding of its underlying strengths, weaknesses, and potential for growth. This knowledge allows them to make more informed and rational decisions that are based on the true value of the business rather than short-term market fluctuations. 1.4.3 Long-term perspective. Intrinsic value encourages decision-makers to adopt a long-term perspective when evaluating business opportunities. Instead of being swayed by short-term market trends or temporary fluctuations, they focus on the underlying value and potential of the business over an extended period. This long-term approach helps in identifying sustainable growth opportunities and avoiding impulsive decisions that may lead to unfavorable outcomes in the future. 1.4.4 Risk management. Intrinsic value analysis plays a crucial role in risk management. By assessing the intrinsic value of a business, decision-makers can identify potential risks and uncertainties that may impact its future performance. This allows them to develop effective risk mitigation strategies and make informed decisions that minimize the potential downside. By considering the intrinsic value, decision-makers can better understand the risk-reward trade-off and make decisions that align with their risk appetite. 1.4.5 Investment allocation. Intrinsic value analysis is instrumental in determining the allocation of resources and investments within a business. By evaluating the intrinsic value of different business units, projects, or investment opportunities, decision-makers can prioritize and allocate resources to areas that offer the highest potential for value creation. This ensures that resources are utilized efficiently and effectively, maximizing the overall value of the business. 1.4.6 Strategic planning. Intrinsic value analysis provides a solid foundation for strategic planning. By understanding the true value of a business, decision-makers can develop strategies that capitalize on its strengths, address its weaknesses, and leverage its growth potential. Intrinsic value analysis helps in identifying strategic opportunities, evaluating potential acquisitions or partnerships, and making decisions that align with the long-term vision and objectives of the organization. 1.4.7 Investor confidence. Intrinsic value analysis is crucial in building investor confidence. By focusing on the intrinsic value of a business, decision-makers can provide transparent and reliable information to investors, shareholders, and other stakeholders. This transparency helps in building trust and confidence in the organization, attracting potential investors, and maintaining a positive reputation in the market. Investors are more likely to invest in businesses that have a strong intrinsic value and demonstrate a commitment to long-term value creation. 1.4.8 Competitive advantage. Intrinsic value analysis enables decision-makers to identify and leverage competitive advantages. By understanding the true value of the business and its unique strengths, they can develop strategies that differentiate the organization from its competitors. This may involve investing in research and development, enhancing operational efficiency, or developing innovative products or services. By focusing on intrinsic value, decision-makers can position the business for long-term success and gain a competitive edge in the market. 1.4.9 Ethical decision-making. Intrinsic value analysis promotes ethical decision-making within organizations. By considering the true value and long-term impact of business decisions, decision-makers are more likely to make choices that align with ethical principles and values. This includes considering the impact on stakeholders, the environment, and society as a whole. Intrinsic value analysis encourages decision-makers to prioritize sustainable and responsible business practices, contributing to the overall well-being of the organization and its stakeholders. 1.4.10 Continuous improvement. Intrinsic value analysis fosters a culture of continuous improvement within organizations. By regularly evaluating the intrinsic value of the business, decision-makers can identify areas for improvement and implement strategies to enhance value creation. This may involve investing in employee development, adopting new technologies, or optimizing operational processes. By focusing on intrinsic value, decision-makers can drive continuous growth and improvement, ensuring the long-term success and sustainability of the business. In conclusion, intrinsic value is of paramount importance in business decision-making. It provides decision-makers with a solid foundation for evaluating opportunities, managing risks, and driving long-term value creation. By considering the intrinsic value of a business, decision-makers can make informed and rational decisions that align with the organization's long-term goals and objectives. Intrinsic value analysis promotes transparency, ethical decision-making, and continuous improvement, contributing to the overall success and sustainability of the business. 2. Financial analysis for determining intrinsic value. 2.1 Financial statements and their role in intrinsic value analysis. Financial statements play a crucial role in the analysis of intrinsic value for a business. These statements provide a comprehensive overview of a company's financial performance, position, and cash flows. By examining these statements, investors and analysts can gain valuable insights into the intrinsic value of a business. 2.1.1 Understanding financial statements. Financial statements are formal records that present the financial activities and position of a company. The three main financial statements are the balance sheet, income statement, and cash flow statement. Each statement provides different information about a company's financial health and performance. Balance sheet. The balance sheet provides a snapshot of a company's financial position at a specific point in time. It presents the company's assets, liabilities, and shareholders' equity. Assets represent what the company owns, liabilities represent what it owes, and shareholders' equity represents the owner's investment in the company. The balance sheet helps investors understand the company's financial stability and its ability to meet its obligations. Income statement. The income statement, also known as the profit and loss statement, shows a company's revenues, expenses, and net income or loss over a specific period. It provides information about the company's ability to generate profits from its operations. By analyzing the income statement, investors can assess the company's profitability, growth potential, and overall financial performance. Cash flow statement. The cash flow statement tracks the inflows and outflows of cash within a company over a specific period. It categorizes cash flows into three main activities: operating, investing, and financing. The cash flow statement helps investors understand how a company generates and uses its cash, providing insights into its liquidity, solvency, and ability to fund future growth. 2.1.2 Role of financial statements in intrinsic value analysis. Financial statements serve as a foundation for assessing the intrinsic value of a business. They provide essential information that helps investors and analysts evaluate the company's financial health, profitability, and growth prospects. Here are some key roles of financial statements in intrinsic value analysis. Assessing financial performance. Financial statements allow investors to evaluate a company's historical financial performance. By analyzing the income statement, investors can assess the company's revenue growth, profit margins, and return on investment. The balance sheet provides insights into the company's asset utilization, debt levels, and equity position. These metrics help investors gauge the company's ability to generate sustainable profits and create value over time. Estimating future cash flows. Intrinsic value analysis heavily relies on estimating a company's future cash flows. The cash flow statement provides valuable information about the company's cash generation and utilization. By examining the cash flow statement, investors can assess the company's ability to generate consistent cash flows, fund its operations, and invest in growth opportunities. These insights are crucial for estimating the future cash flows that form the basis of intrinsic value calculations. Identifying risks and opportunities. Financial statements help investors identify potential risks and opportunities associated with a business. By analyzing the income statement, balance sheet, and cash flow statement, investors can identify trends, patterns, and anomalies that may impact the company's intrinsic value. For example, a declining profit margin or increasing debt levels may indicate potential risks, while a growing customer base or expanding profit margins may indicate opportunities for value creation. Comparing performance with peers. Financial statements enable investors to compare a company's performance with its industry peers. By benchmarking key financial metrics, such as revenue growth, profitability, and return on investment, investors can assess the company's competitive position and relative intrinsic value. This comparative analysis helps investors identify companies that are undervalued or overvalued within their industry, providing opportunities for potential investments. 2.1.3 Limitations of financial statements in intrinsic value analysis. While financial statements provide valuable insights into a company's intrinsic value, it is important to recognize their limitations. Here are some limitations to consider. Historical nature. Financial statements primarily reflect historical data, providing a snapshot of the company's past performance. Intrinsic value analysis requires estimating future cash flows, which may not be accurately reflected in historical financial statements. Therefore, investors need to supplement financial statement analysis with other forecasting techniques to account for future uncertainties. Subjectivity and assumptions. Intrinsic value analysis involves making assumptions and subjective judgments about a company's future prospects. Financial statements alone may not capture all the relevant information needed to make accurate projections. Investors must consider external factors, industry trends, and management's strategic decisions to make informed assessments of a company's intrinsic value. Limited scope. Financial statements provide a quantitative analysis of a company's financial performance but may not capture qualitative factors that can impact intrinsic value. Factors such as brand reputation, customer loyalty, and intellectual property may not be adequately reflected in financial statements. Investors should consider both quantitative and qualitative factors when assessing a company's intrinsic value. In conclusion, financial statements play a crucial role in the analysis of intrinsic value for a business. They provide valuable information about a company's financial performance, position, and cash flows. By examining these statements, investors can assess a company's financial health, profitability, and growth prospects, which are essential for estimating its intrinsic value. However, it is important to recognize the limitations of financial statements and supplement their analysis with other techniques to make accurate assessments of a company's intrinsic value. 2.2 Key financial ratios for assessing intrinsic value. Financial ratios play a crucial role in assessing the intrinsic value of a business. These ratios provide valuable insights into the financial health and performance of a company, allowing investors and analysts to make informed decisions about its intrinsic value. By analyzing various financial ratios, stakeholders can gain a deeper understanding of a company's profitability, liquidity, efficiency, and overall financial stability. 2.2.1 Profitability ratios. Profitability ratios are essential in evaluating a company's ability to generate profits and create value for its shareholders. These ratios measure the company's profitability in relation to its sales, assets, and equity. Some key profitability ratios include gross profit margin. The gross profit margin indicates the percentage of revenue that remains after deducting the cost of goods sold. It reflects the company's ability to generate profits from its core operations. A higher gross profit margin suggests that the company has a competitive advantage in controlling production costs and pricing its products or services. Net profit margin. The net profit margin measures the percentage of revenue that remains as net income after deducting all expenses, including taxes and interest. It provides insights into the company's overall profitability and efficiency in managing its costs. A higher net profit margin indicates better profitability and effective cost management. Return on assets (ROA). Return on assets measures the company's ability to generate profits from its total assets. It shows how efficiently the company utilizes its assets to generate income. A higher ROA indicates that the company is effectively utilizing its assets to generate profits. Return on equity (ROE). Return on equity measures the company's ability to generate profits from the shareholders' equity. It indicates how well the company is utilizing the shareholders' investments to generate returns. A higher ROE suggests that the company is effectively utilizing its equity to generate profits. 2.2.2 Liquidity ratios. Liquidity ratios assess a company's ability to meet its short-term obligations and manage its cash flow effectively. These ratios provide insights into the company's financial flexibility and its ability to handle unexpected financial challenges. Some key liquidity ratios include current ratio. The current ratio measures the company's ability to meet its short-term obligations using its current assets. It is calculated by dividing current assets by current liabilities. A higher current ratio indicates that the company has sufficient current assets to cover its short-term liabilities. Quick ratio. The quick ratio, also known as the acid test ratio, is a more stringent measure of liquidity. It excludes inventory from current assets since inventory may not be easily converted into cash. The quick ratio is calculated by dividing quick assets, current assets minus inventory, by current liabilities. A higher quick ratio suggests that the company has a stronger ability to meet its short-term obligations without relying on inventory. 2.2.3 Efficiency ratios. Efficiency ratios evaluate a company's operational efficiency and its ability to manage its assets and liabilities effectively. These ratios provide insights into how well the company utilizes its resources to generate revenue and control costs. Some key efficiency ratios include inventory turnover ratio. The inventory turnover ratio measures how quickly a company sells its inventory and replaces it with new stock. It is calculated by dividing the cost of goods sold by the average inventory. A higher inventory turnover ratio indicates that the company is effectively managing its inventory and generating sales. Accounts receivable turnover ratio. The accounts receivable turnover ratio measures how quickly a company collects payments from its customers. It is calculated by dividing net credit sales by the average accounts receivable. A higher accounts receivable turnover ratio suggests that the company has efficient credit and collection policies. Asset turnover ratio. The asset turnover ratio measures how efficiently a company utilizes its assets to generate sales. It is calculated by dividing net sales by average total assets. A higher asset turnover ratio indicates that the company is effectively utilizing its assets to generate revenue. 2.2.4 Debt and solvency ratios. Debt and solvency ratios assess a company's ability to meet its long-term obligations and manage its debt levels. These ratios provide insights into the company's financial stability and its ability to withstand financial challenges. Some key debt and solvency ratios include debt-to-equity ratio. The debt-to-equity ratio measures the proportion of a company's financing that comes from debt compared to equity. It is calculated by dividing total debt by total equity. A higher debt-to-equity ratio indicates that the company relies more on debt financing, which may increase its financial risk. Interest coverage ratio. The interest coverage ratio measures a company's ability to meet its interest payments using its operating income. It is calculated by dividing operating income by interest expenses. A higher interest coverage ratio suggests that the company has sufficient earnings to cover its interest obligations. Debt ratio. The debt ratio measures the proportion of a company's assets that are financed by debt. It is calculated by dividing total debt by total assets. A higher debt ratio indicates that the company has a higher level of debt relative to its assets. By analyzing these key financial ratios, investors and analysts can gain valuable insights into a company's financial performance and its intrinsic value. However, it is important to consider these ratios in conjunction with other factors such as industry benchmarks, market conditions, and qualitative aspects of the business to make a comprehensive assessment of a company's intrinsic value. 2.3 Cash flow analysis and its impact on intrinsic value. Cash flow analysis is a crucial component in determining the intrinsic value of a business. It provides valuable insights into the financial health and sustainability of a company by examining the inflows and outflows of cash over a specific period. By analyzing the cash flow statement, investors and analysts can gain a deeper understanding of a company's ability to generate cash, meet its financial obligations, and create value for its shareholders. 2.3.1 Importance of cash flow analysis. Cash flow analysis is essential because it focuses on the actual cash generated by a business, rather than accounting profits. While accounting profits are important, they can be influenced by non-cash items such as depreciation and amortization, which may not accurately reflect the company's financial position. Cash flow analysis provides a more accurate picture of a company's ability to generate cash and its overall financial performance. Furthermore, cash flow analysis helps investors and analysts assess the sustainability of a company's operations. It allows them to evaluate whether a company is generating sufficient cash to cover its operating expenses, debt obligations, and capital expenditures. By understanding the cash flow dynamics of a business, investors can make more informed decisions about its intrinsic value and potential for long-term growth. 2.3.2 Components of cash flow analysis. Cash flow analysis involves examining three key components: operating cash flow, investing cash flow, and financing cash flow. Operating cash flow. Operating cash flow represents the cash generated or used by a company's core operations. It includes cash inflows from sales revenue, interest income, and other operating activities, as well as cash outflows for operating expenses, taxes, and interest payments. Positive operating cash flow indicates that a company's operations are generating more cash than they are consuming, which is a positive sign for its intrinsic value. Investing cash flow. Investing cash flow reflects the cash used for or generated from investments in long-term assets, such as property, plant, and equipment, as well as investments in other companies. Positive investing cash flow suggests that a company is investing in its future growth and expansion, which can contribute to its intrinsic value. Conversely, negative investing cash flow may indicate that a company is divesting assets or facing challenges in generating profitable investments. Financing cash flow. Financing cash flow represents the cash generated or used from activities related to the company's capital structure. It includes cash inflows from issuing debt or equity, as well as cash outflows from debt repayments, dividend payments, and share repurchases. Positive financing cash flow indicates that a company has access to capital and can meet its financial obligations, which can positively impact its intrinsic value. 2.3.3 Cash flow metrics for intrinsic value analysis. Several key metrics derived from cash flow analysis are used to assess a company's intrinsic value. These metrics provide insights into the company's cash generation, liquidity, and ability to generate returns for its shareholders. Some of the commonly used cash flow metrics include free cash flow (FCF). Free cash flow is a measure of the cash available to the company after deducting capital expenditures required to maintain and expand its operations. It represents the cash that can be used for debt repayment, dividend payments, share repurchases, or reinvestment in the business. Positive free cash flow is indicative of a company's ability to generate excess cash and create value for its shareholders. Cash flow return on investment (CFROI). Cash flow return on investment is a ratio that measures the cash generated by a company's operations relative to its invested capital. It provides insights into the efficiency and profitability of a company's operations. A higher CFROI indicates that a company is generating more cash relative to its invested capital, which can positively impact its intrinsic value. Cash flow margin. Cash flow margin is a measure of a company's ability to convert its sales revenue into cash flow. It is calculated by dividing operating cash flow by sales revenue. A higher cash flow margin indicates that a company is efficient in converting its sales into cash, which can contribute to its intrinsic value. 2.3.4 Impact of cash flow analysis on intrinsic value. Cash flow analysis plays a significant role in determining the intrinsic value of a business. By examining the cash flow statement and analyzing the various cash flow metrics, investors and analysts can gain insights into a company's financial health, profitability, and ability to generate cash. Positive cash flow metrics, such as strong free cash flow, high cash flow return on investment, and healthy cash flow margins, indicate that a company is generating sufficient cash to cover its expenses, invest in growth opportunities, and reward its shareholders. These positive cash flow indicators can contribute to a higher intrinsic value for the business. On the other hand, negative cash flow metrics, such as negative free cash flow, low cash flow return on investment, and weak cash flow margins, may suggest that a company is struggling to generate cash or efficiently manage its operations. These negative cash flow indicators can lead to a lower intrinsic value for the business. In conclusion, cash flow analysis is a critical tool for assessing the intrinsic value of a business. By examining the components of cash flow, analyzing key cash flow metrics, and understanding their impact on a company's financial performance, investors and analysts can make more informed decisions about the intrinsic value and potential of a business. 2.4 Earnings quality and its influence on intrinsic value. Earnings quality plays a crucial role in determining the intrinsic value of a business. It refers to the reliability and sustainability of a company's earnings, which directly impacts its long-term profitability and value. Investors and analysts closely examine the quality of a company's earnings to assess its true worth and make informed investment decisions. 2.4.1 Understanding earnings quality. Earnings quality is a measure of the accuracy and transparency of a company's financial statements, particularly its income statement. It reflects the extent to which reported earnings reflect the underlying economic performance of the business. High-quality earnings are considered to be reliable, consistent, and sustainable over time, while low-quality earnings may be subject to manipulation, volatility, or uncertainty. To evaluate earnings quality, analysts focus on several key factors. 2.4.1.1 Revenue recognition. Revenue recognition is a critical aspect of earnings quality. Companies must accurately record and recognize revenue when it is earned and realizable. Manipulating revenue recognition can artificially inflate earnings, leading to misleading financial statements. Therefore, investors assess the consistency and transparency of a company's revenue recognition policies and practices. 2.4.1.2 Expense management. Effective expense management is essential for maintaining earnings quality. Companies should control costs and allocate expenses accurately to reflect the true operational performance. Manipulating expenses can distort earnings and misrepresent the financial health of a business. Investors analyze expense patterns and trends to assess the reliability of reported earnings. 2.4.1.3 Accounting policies and practices. The accounting policies and practices adopted by a company significantly impact earnings quality. Consistent and conservative accounting principles enhance the reliability of financial statements. Conversely, aggressive accounting practices or the use of subjective estimates can introduce uncertainty and reduce earnings quality. Investors scrutinize a company's accounting policies to evaluate the credibility of its reported earnings. 2.4.1.4 Cash flow generation. The ability of a company to generate consistent and sustainable cash flows is a key indicator of earnings quality. Positive cash flows validate reported earnings and provide evidence of a company's ability to generate profits. Investors analyze the cash flow statement to assess the quality of earnings and determine if they are supported by actual cash inflows. 2.4.2 Impact on intrinsic value. Earnings quality directly influences the intrinsic value of a business. High-quality earnings are more likely to reflect the true economic value of a company and provide a reliable basis for estimating future cash flows. On the other hand, low-quality earnings can distort the assessment of a company's worth and lead to inaccurate valuations. 2.4.2.1 Accurate valuation. Intrinsic value calculations heavily rely on accurate and reliable earnings data. When assessing a company's worth, analysts often use valuation models such as discounted cash flow, DCF, analysis or relative valuation methods. These models require accurate earnings projections and historical data to estimate future cash flows and determine an appropriate valuation multiple. High-quality earnings enhance the accuracy of these calculations, resulting in a more reliable intrinsic value estimate. 2.4.2.2 Investor confidence. Earnings quality significantly impacts investor confidence and perception of a company's value. Investors prefer businesses with a track record of consistent and reliable earnings, as it provides them with a sense of stability and predictability. High-quality earnings instill confidence in investors, attracting more interest and potentially leading to a higher valuation. Conversely, low-quality earnings can erode investor trust and negatively impact a company's intrinsic value. 2.4.2.3 Risk Assessment. Earnings quality is closely linked to the assessment of business risks. Companies with high-quality earnings are often perceived as having lower risk profiles, as their financial statements accurately reflect their underlying performance. On the other hand, businesses with low-quality earnings may be associated with higher risk due to potential earnings manipulation or uncertainty. Investors consider earnings quality as a crucial factor when evaluating the risk-reward trade-off and determining the appropriate discount rate for future cash flows. 2.4.3 Evaluating earnings quality. Assessing earnings quality requires a comprehensive analysis of a company's financial statements and accounting practices. Investors and analysts employ various techniques to evaluate the reliability and sustainability of reported earnings. Some common methods include 2.4.3.1 Ratio analysis. Ratio analysis involves examining financial ratios that provide insights into a company's earnings quality. Ratios such as the gross profit margin, operating profit margin, and return on equity (ROE) can indicate the profitability and efficiency of a business. Consistent and improving ratios over time suggest higher earnings quality. 2.4.3.2 Comparative analysis. Comparative analysis involves benchmarking a company's financial performance against its industry peers. By comparing key financial metrics and ratios, analysts can identify any significant deviations that may indicate potential earnings manipulation or lower earnings quality. 2.4.3.3 Audit quality. The quality of a company's external audit can provide assurance regarding the accuracy and reliability of its financial statements. A reputable and independent audit firm enhances the credibility of reported earnings and increases investor confidence. 2.4.3.4 Management integrity. Assessing the integrity and reputation of a company's management team is crucial in evaluating earnings quality. Transparent communication, ethical behavior, and a history of conservative accounting practices are indicators of higher earnings quality. In conclusion, earnings quality is a critical factor in determining the intrinsic value of a business. High-quality earnings enhance the accuracy of valuation models, instill investor confidence, and provide a reliable basis for estimating future cash flows. Evaluating earnings quality requires a thorough analysis of a company's financial statements, accounting practices, and other relevant factors. Investors and analysts should consider earnings quality as a fundamental aspect of their intrinsic value assessment process. 3. Market analysis and intrinsic value. 3.1 Understanding market efficiency and intrinsic value. Market efficiency plays a crucial role in determining the intrinsic value of a business. In order to comprehend the relationship between market efficiency and intrinsic value, it is essential to first understand what intrinsic value represents. 3.1.1 Defining intrinsic value. Intrinsic value refers to the true worth or value of a business, independent of its current market price. It is the underlying value that an asset or a business possesses based on its fundamental characteristics, such as its cash flows, earnings potential, growth prospects, and risk profile. Intrinsic value represents the estimated value of an investment based on its underlying fundamentals, rather than relying solely on market sentiment or short-term fluctuations. 3.1.2 Market efficiency and intrinsic value. Market efficiency refers to the degree to which prices of assets or securities reflect all available information. In an efficient market, prices quickly adjust to new information, making it difficult for investors to consistently outperform the market. The efficiency of a market can have a significant impact on the determination of intrinsic value. In an efficient market, the current market price of a business is likely to closely reflect its intrinsic value. This means that investors would find it challenging to identify undervalued or overvalued businesses, as market prices would accurately reflect their true worth. On the other hand, in an inefficient market, there may be opportunities for investors to identify mispriced assets and potentially profit from the difference between market price and intrinsic value. 3.1.3 Efficient market hypothesis. The concept of market efficiency is closely associated with the efficient market hypothesis (EMH). The EMH suggests that financial markets are efficient and that it is impossible to consistently achieve above-average returns by using publicly available information. According to the EMH, all relevant information is quickly and accurately reflected in market prices, leaving no room for investors to consistently outperform the market. There are three forms of market efficiency proposed by the EMH. Weak form efficiency. In this form, market prices reflect all past publicly available information, such as historical prices and trading volumes. Therefore, technical analysis, which relies on historical price patterns, would not provide an advantage in identifying mispriced assets. Semi-strong form efficiency. In addition to past information, market prices also reflect all publicly available information, including financial statements, news releases, and other market-related information. As a result, fundamental analysis, which involves analyzing financial statements and other relevant information, would not consistently lead to above-average returns. Strong form efficiency. Market prices reflect all information, including both publicly available and private information. In this form, even insider information would not provide an advantage, as it is already incorporated into market prices. 3.1.4 Implications for intrinsic value analysis. The level of market efficiency has implications for investors and their ability to accurately determine the intrinsic value of a business. In an efficient market, where prices accurately reflect intrinsic value, investors would need to rely on accurate and reliable financial analysis to identify mispriced assets. Fundamental analysis, including financial statement analysis, cash flow analysis, and earnings quality assessment, becomes crucial in determining the true worth of a business. On the other hand, in an inefficient market, where prices deviate from intrinsic value, investors may have opportunities to identify undervalued or overvalued businesses. In such cases, investors can use various valuation techniques, such as discounted cash flow analysis, relative valuation methods, and market valuation models, to estimate the intrinsic value and make investment decisions accordingly. Understanding the level of market efficiency is essential for investors as it helps them determine the appropriate approach to valuing businesses. By considering the efficiency of the market, investors can align their valuation methods and strategies to maximize their chances of identifying mispriced assets and making informed investment decisions. In conclusion, market efficiency and intrinsic value are closely intertwined. In an efficient market, prices accurately reflect intrinsic value, making it challenging for investors to consistently outperform the market. However, in an inefficient market, opportunities may arise for investors to identify mispriced assets and potentially profit from the difference between market price and intrinsic value. Understanding the level of market efficiency is crucial for investors to determine the appropriate valuation methods and strategies to assess the intrinsic value of a business. 3.2 Comparative analysis and intrinsic value. Comparative analysis plays a crucial role in determining the intrinsic value of a business. By comparing a company's financial performance, market position, and other relevant factors with its industry peers, investors and analysts can gain valuable insights into the true worth of the business. This analysis helps in understanding how the company is performing relative to its competitors and provides a benchmark for evaluating its intrinsic value. 3.2.1 Importance of comparative analysis. Comparative analysis allows investors to assess a company's competitive advantage, growth potential, and financial health in relation to its peers. It provides a comprehensive view of the company's strengths and weaknesses, enabling investors to make informed decisions about its intrinsic value. By comparing key financial metrics, such as revenue growth, profitability, and return on investment, investors can identify whether a company is outperforming or underperforming its competitors. Furthermore, comparative analysis helps in identifying industry trends and market dynamics that may impact the intrinsic value of a business. By analyzing the performance of similar companies within the same industry, investors can gain insights into the overall health and growth prospects of the sector. This information is crucial for determining the intrinsic value of a business, as it provides a broader context for evaluating its financial performance and market position. 3.2.2 Key metrics for comparative analysis. When conducting a comparative analysis, several key metrics are commonly used to assess a company's intrinsic value. These metrics provide a quantitative basis for comparing the financial performance and market position of a business with its peers. Some of the key metrics include: 1. Revenue growth. Revenue growth is a fundamental indicator of a company's ability to generate sales and expand its market share. By comparing a company's revenue growth rate with its industry peers, investors can assess its competitive position and growth potential. Higher revenue growth relative to competitors may indicate a stronger intrinsic value. 2. Profitability ratios. Profitability ratios, such as gross profit margin, operating profit margin, and net profit margin, provide insights into a company's ability to generate profits from its operations. Comparing these ratios with industry benchmarks helps investors evaluate the company's efficiency and profitability. A higher profitability ratio compared to competitors may suggest a higher intrinsic value. 3. Return on investment (ROI). Return on investment measures the profitability of an investment relative to its cost. By comparing a company's ROI with its industry peers, investors can assess its ability to generate returns for shareholders. A higher ROI compared to competitors may indicate a higher intrinsic value. 4. Market share. Market share represents the portion of a market that a company controls. By comparing a company's market share with its competitors, investors can evaluate its competitive position and market dominance. A larger market share relative to competitors may suggest a higher intrinsic value. 5. Price-to-earnings (P/E) ratio. The P/E ratio compares a company's stock price to its earnings per share (EPS). By comparing a company's P/E ratio with its industry peers, investors can assess its valuation relative to its earnings. A lower P/E ratio compared to competitors may indicate an undervalued stock and a higher intrinsic value. 3.2.3 Limitations of comparative analysis. While comparative analysis provides valuable insights into a company's intrinsic value, it is important to acknowledge its limitations. Firstly, the availability and accuracy of data can vary across companies and industries, making it challenging to conduct a comprehensive analysis. Additionally, companies within the same industry may have different business models, strategies, and risk profiles, which can affect their intrinsic value. Furthermore, comparative analysis relies on historical data and may not fully capture future growth prospects or industry disruptions. It is essential to complement comparative analysis with other valuation techniques, such as discounted cash flow analysis or real options analysis, to obtain a more comprehensive understanding of a company's intrinsic value. 3.2.4 Case Study, Comparative Analysis in Action. To illustrate the practical application of comparative analysis in determining intrinsic value, let's consider a case study. Suppose we are analyzing two companies in the technology sector, Company A and Company B. By comparing their financial statements, we find that Company A has a higher revenue growth rate, profitability ratios, and market share compared to Company B. Additionally, Company A has a lower P/E ratio, indicating a relatively lower valuation compared to its earnings. Based on this comparative analysis, we can infer that Company A may have a higher intrinsic value compared to Company B. However, it is important to consider other factors such as the company's competitive advantages, management quality, and industry trends before making a final assessment of their intrinsic value. Conclusion. Comparative analysis is a powerful tool for determining the intrinsic value of a business. By comparing a company's financial performance, market position, and other relevant factors with its industry peers, investors can gain valuable insights into its true worth. Key metrics such as revenue growth, profitability ratios, market share, and P/E ratio provide a quantitative basis for evaluating a company's intrinsic value. However, it is crucial to acknowledge the limitations of comparative analysis and complement it with other valuation techniques to obtain a comprehensive understanding of a company's intrinsic value. 3.3 Industry Analysis and its relationship to intrinsic value. Industry analysis plays a crucial role in determining the intrinsic value of a business. It provides valuable insights into the external factors that can significantly impact a company's performance and future prospects. By understanding the dynamics of the industry in which a business operates, investors and analysts can make more informed decisions about the intrinsic value of the company. 3.3.1 Understanding the industry landscape. To assess the intrinsic value of a business, it is essential to have a comprehensive understanding of the industry in which it operates. Industry analysis involves evaluating various factors such as market size, growth rate, competition, regulatory environment, and technological advancements. This analysis helps in identifying the opportunities and challenges that the industry presents, which directly influence the intrinsic value of a business. 3.3.2 Market Structure and Competitive Forces. Industry analysis involves examining the market structure and competitive forces at play. Different industries have varying levels of competition, ranging from monopolistic to highly competitive markets. Understanding the competitive landscape is crucial as it directly impacts a company's ability to generate profits and sustain its competitive advantage. Industries with high barriers to entry and limited competition tend to have higher intrinsic values as they offer greater profit potential. 3.3.3 Industry Growth and Market Demand. The growth prospects of an industry significantly influence the intrinsic value of a business. Industries experiencing rapid growth tend to attract more investors and have higher valuations. Conversely, industries with stagnant or declining growth rates may have lower intrinsic values. Market demand is a critical factor in determining industry growth. Analyzing factors such as population trends, consumer preferences, and economic conditions helps in assessing the future demand for products or services within the industry. 3.3.4 Technological Advancements and Innovation. Technological advancements play a vital role in shaping industries and their intrinsic values. Industries that embrace innovation and adapt to technological changes tend to have higher intrinsic values. Technological advancements can lead to increased efficiency, cost savings, and the development of new products or services. Investors and analysts need to evaluate the industry's ability to adopt and leverage technology to assess its impact on the intrinsic value of a business. 3.3.5 Regulatory Environment and Legal Factors. The regulatory environment and legal factors have a significant influence on the intrinsic value of a business. Industries that are heavily regulated or subject to stringent legal requirements may face higher compliance costs and operational challenges. Changes in regulations can impact the industry's profitability and growth potential, thereby affecting the intrinsic value of businesses operating within it. Analyzing the regulatory landscape is crucial to understanding the risks and opportunities associated with the industry. 3.3.6 Supply Chain Analysis. Analyzing the supply chain within an industry provides insights into the cost structure, efficiency, and potential risks. Understanding the suppliers, distributors, and other stakeholders involved in the industry helps in assessing the overall competitiveness and profitability of a business. Supply chain disruptions or inefficiencies can impact a company's ability to generate profits and, consequently, its intrinsic value. 3.3.7 Industry Trends and Competitive Advantage. Identifying industry trends and assessing a company's competitive advantage within the industry is essential in determining its intrinsic value. Industry trends such as changing consumer preferences, emerging markets, and disruptive technologies can create opportunities or pose threats to businesses. Companies with a sustainable competitive advantage, such as strong brand recognition, intellectual property, or unique capabilities, tend to have higher intrinsic values as they are better positioned to capitalize on industry trends and outperform competitors. 3.3.8 Industry Risk Assessment. Industry analysis involves evaluating the risks associated with the industry. Every industry has its own set of risks, including economic downturns, technological obsolescence, regulatory changes, and competitive pressures. Assessing these risks helps in understanding the potential impact on a company's intrinsic value. Industries with higher inherent risks may have lower intrinsic values, as investors require a higher return to compensate for the additional risk. 3.3.9 Industry Outlook and Future Prospects. Analyzing the industry's outlook and future prospects is crucial in determining the intrinsic value of a business. Factors such as market growth potential, emerging trends, and disruptive forces shape the industry's future trajectory. Industries with favorable long-term prospects tend to have higher intrinsic values, as they offer greater growth opportunities and potential returns for investors. In conclusion, industry analysis is a fundamental component of assessing the intrinsic value of a business. By understanding the industry landscape, competitive forces, growth prospects, technological advancements, regulatory environment, and other factors, investors and analysts can make more accurate evaluations of a company's intrinsic value. Industry analysis provides valuable insights into the external factors that can significantly impact a business's performance and future prospects, allowing stakeholders to make informed investment decisions. 3.4 Market Sentiment and Intrinsic Value. Market sentiment plays a crucial role in determining the intrinsic value of a business. It refers to the overall attitude or feeling of investors and market participants towards a particular stock, industry, or the market as a whole. Market sentiment can be influenced by a variety of factors, including economic conditions, news events, investor behavior, and market trends. Understanding market sentiment is essential for investors and analysts as it can have a significant impact on the perceived value of a business. 3.4.1 The Role of Market Sentiment. Market sentiment can have a profound effect on the intrinsic value of a business. It can either amplify or diminish the perceived value of a company, regardless of its fundamental strengths or weaknesses. When market sentiment is positive, investors tend to have a favorable view of a company's prospects, leading to an increase in its perceived value. Conversely, when market sentiment is negative, investors may have a pessimistic outlook, resulting in a decrease in the perceived value of the business. 3.4.2 Emotional Factors and Market Sentiment. Market sentiment is heavily influenced by emotional factors such as fear, greed, and optimism. These emotions can drive investors to make irrational decisions, causing the market to deviate from the intrinsic value of a business. For example, during periods of market euphoria, investors may become overly optimistic and bid up the prices of stocks, leading to an inflated perception of a company's value. Conversely, during times of market panic, fear can drive investors to sell off stocks, causing prices to plummet below their intrinsic value. 3.4.3 Behavioral Biases and Market Sentiment. Market sentiment is also influenced by various behavioral biases that can distort the perception of a business's intrinsic value. Cognitive biases, such as confirmation bias and herd mentality, can lead investors to rely on information that confirms their pre-existing beliefs or follow the crowd without conducting thorough analysis. These biases can cause market sentiment to become detached from the true intrinsic value of a business, leading to market inefficiencies and potential investment opportunities for astute investors. 3.4.4 Impact on investment decisions. Market sentiment can significantly impact investment decisions. When market sentiment is positive, investors may be willing to pay a premium for a stock, believing that its value will continue to rise. Conversely, when market sentiment is negative, investors may be reluctant to invest, even if a company's fundamentals suggest that it is undervalued. Understanding market sentiment is crucial for investors as it can help them identify opportunities to buy stocks at a discount or avoid overvalued stocks during periods of market exuberance. 3.4.5 Market Sentiment Indicators. To gauge market sentiment, investors and analysts often rely on various indicators and tools. These indicators can provide insights into the overall mood of the market and help assess whether sentiment is bullish or bearish. Some commonly used market sentiment indicators include sentiment surveys, surveys that measure the opinions and expectations of investors and market participants. These surveys can provide a snapshot of market sentiment and help identify trends and shifts in investor sentiment. Volatility Index (VIX), also known as the Fear Index. The VIX measures the market's expectation of volatility over the next 30 days. A high VIX indicates increased market uncertainty and potentially negative sentiment, while a low VIX suggests a more positive outlook. Put-call ratio. The put-call ratio compares the number of put options, bearish bets, to call options, bullish bets, traded on the market. A high put-call ratio indicates bearish sentiment, while a low ratio suggests bullish sentiment. Technical analysis. Technical analysis involves studying price patterns, trends, and other market indicators to identify potential shifts in sentiment. Chart patterns, moving averages, and momentum indicators are commonly used in technical analysis. 3.4.6 Incorporating market sentiment into intrinsic value analysis. When assessing the intrinsic value of a business, it is essential to consider market sentiment alongside fundamental analysis. While fundamental analysis focuses on a company's financials, market sentiment provides insights into how the market perceives the company's value. By incorporating market sentiment into intrinsic value analysis, investors can gain a more comprehensive understanding of a business's true worth. However, it is crucial to exercise caution when relying solely on market sentiment to determine intrinsic value. Market sentiment can be fickle and prone to irrational swings, leading to mispricing of stocks. Therefore, it is essential to combine market sentiment analysis with a thorough evaluation of a company's financials, industry dynamics, and competitive positioning to arrive at a more accurate assessment of its intrinsic value. In conclusion, market sentiment plays a significant role in determining the intrinsic value of a business. It can amplify or diminish the perceived value of a company, often driven by emotional factors and behavioral biases. Understanding market sentiment and incorporating it into intrinsic value analysis can help investors make more informed investment decisions and identify opportunities in the market. However, it is crucial to balance market sentiment with fundamental analysis to avoid potential mispricing and ensure a more accurate assessment of a business's intrinsic value. 3.5 Market timing and its impact on intrinsic value. Market timing refers to the practice of trying to predict the future movements of the financial markets in order to make investment decisions. It involves attempting to buy or sell assets at the most opportune times, based on the belief that prices will rise or fall in the near future. Market timing can have a significant impact on the intrinsic value of a business, as it directly affects the price at which its shares are bought or sold. 3.5.1 Understanding market timing. Market timing is a challenging task, as it requires accurately predicting the direction and timing of market movements. Many investors and traders attempt to time the market in order to maximize their profits or minimize their losses. However, it is important to note that market timing is notoriously difficult, and even experienced professionals often struggle to consistently make accurate predictions. 3.5.2 The impact of market timing on intrinsic value. The impact of market timing on the intrinsic value of a business can be significant. Intrinsic value is the true underlying value of a business, based on its fundamental characteristics and future cash flows. It is independent of market fluctuations and represents the long-term worth of the business. When market timing is successful, investors can buy or sell shares of a business at prices that are significantly different from its intrinsic value. For example, if an investor accurately predicts that the market will experience a downturn, they may be able to buy shares of a business at a discounted price, below its intrinsic value. This can result in a higher potential return on investment when the market eventually recovers. Conversely, if an investor times the market incorrectly and buys shares of a business at a price that is higher than its intrinsic value, they may experience a loss when the market corrects itself. This is because the market price of a business tends to revert to its intrinsic value over time, as market participants reassess the true worth of the business based on its fundamentals. 3.5.3 Challenges of market timing. While successful market timing can lead to significant gains, it is important to recognize the challenges associated with this practice. Timing the market requires accurate predictions of future market movements, which is extremely difficult to achieve consistently. Even professional investors and traders with access to extensive resources and information often struggle to time the market accurately. Attempting to time the market can also lead to increased transaction costs. Buying and selling assets frequently in an attempt to take advantage of short-term market movements can result in higher brokerage fees and taxes, which can eat into potential profits. Furthermore, market timing can be emotionally challenging for investors. The fear of missing out on potential gains or the fear of incurring losses can lead to impulsive and irrational investment decisions. Emotions such as greed and fear can cloud judgment and lead to poor investment outcomes. 3.5.4 Long-term investing and intrinsic value. An alternative approach to market timing is long-term investing based on the intrinsic value of a business. Instead of trying to predict short-term market movements, long-term investors focus on the fundamental characteristics of a business and its potential for generating sustainable cash flows over time. By investing in businesses with strong fundamentals and attractive long-term prospects, investors can potentially benefit from the compounding effect of returns over time. This approach is often associated with value investing, where investors seek to buy shares of businesses that are trading at a discount to their intrinsic value. Long-term investing based on intrinsic value allows investors to avoid the pitfalls of market timing and take advantage of the true worth of a business. By focusing on the underlying value of a business rather than short-term market fluctuations, investors can make more informed and rational investment decisions. 3.5.5 Conclusion. Market timing can have a significant impact on the intrinsic value of a business. Successful market timing can result in buying or selling shares at prices that deviate from the intrinsic value, potentially leading to higher returns or losses. However, accurately predicting market movements is challenging, and market timing can be emotionally and financially costly. An alternative approach is to focus on long-term investing based on the intrinsic value of a business. By investing in businesses with strong fundamentals and attractive long-term prospects, investors can potentially benefit from the compounding effect of returns over time. This approach allows investors to avoid the challenges of market timing and make more informed investment decisions. 3.6 Market valuation models for assessing intrinsic value. Market valuation models play a crucial role in assessing the intrinsic value of a business. These models provide a systematic approach to determine the worth of a company based on various market factors and financial indicators. By utilizing these models, investors and analysts can make informed decisions about buying or selling stocks, evaluating investment opportunities, and understanding the true value of a business. 3.6.1 Discounted Cash Flow (DCF) Model. One of the most widely used market valuation models is the Discounted Cash Flow (DCF) model. This model estimates the intrinsic value of a business by calculating the present value of its expected future cash flows. The DCF model takes into account the time value of money, which means that future cash flows are discounted to their present value using an appropriate discount rate. To apply the DCF model, analysts need to forecast the future cash flows of the business and determine an appropriate discount rate. The cash flows can be estimated by considering historical financial data, industry trends, and future growth prospects. The discount rate is typically derived from the company's cost of capital, which reflects the risk associated with the business and the expected return demanded by investors. By discounting the future cash flows, the DCF model provides a fair value estimate for the business. If the calculated intrinsic value is higher than the current market price, it suggests that the stock is undervalued and may be a good investment opportunity. Conversely, if the intrinsic value is lower than the market price, it indicates that the stock is overvalued and may not be a wise investment choice. 3.6.2 Comparable Company Analysis. Another commonly used market valuation model is the Comparable Company Analysis (CCA). This model determines the intrinsic value of a business by comparing it to similar companies in the same industry. By analyzing the financial performance and valuation multiples of comparable companies, analysts can estimate the value of the target business. To perform a CCA, analysts identify a group of comparable companies that have similar business models, size, growth prospects, and risk profiles. They then analyze key financial metrics such as price-to-earnings ratio (PE), price-to-sales ratio (PS), and price-to-book ratio (PP) for both the target company and its peers. By comparing these ratios, analysts can assess whether the target company is undervalued or overvalued relative to its industry peers. The CCA model relies on the assumption that similar companies should have similar valuation multiples. If the target company has lower valuation multiples compared to its peers, it suggests that the stock may be undervalued. Conversely, if the target company has higher valuation multiples, it may indicate that the stock is overvalued. 3.6.3 Dividend Discount Model (DDM). The dividend discount model (DDM) is a market valuation model specifically used for valuing dividend-paying stocks. This model estimates the intrinsic value of a business by calculating the present value of its expected future dividends. The DDM assumes that the value of a stock is equal to the present value of all its future dividend payments. To apply the DDM, analysts need to forecast the future dividends of the business and determine an appropriate discount rate. The dividend forecasts can be based on historical dividend payments, earnings growth projections, and the company's dividend policy. The discount rate used in the DDM is typically the company's cost of equity, which reflects the return required by shareholders to invest in the stock. The DDM model is particularly useful for investors who prioritize dividend income. By estimating the intrinsic value of a dividend-paying stock, investors can assess whether the stock is undervalued or overvalued. If the calculated intrinsic value is higher than the market price, it suggests that the stock may be a good investment for income-oriented investors. Conversely, if the intrinsic value is lower than the market price, it may indicate that the stock is overvalued and may not provide an attractive dividend yield. 3.6.4 Market Valuation Models and Limitations. While market valuation models provide valuable insights into the intrinsic value of a business, it is important to acknowledge their limitations. These models rely on various assumptions and forecasts, which may not always accurately reflect the future performance of a company. Additionally, market conditions and investor sentiment can significantly impact stock prices, leading to deviations from the calculated intrinsic value. Moreover, market valuation models are based on historical and current data, which may not capture the full potential of a business or account for future market disruptions. Therefore, it is essential for investors and analysts to exercise caution and consider multiple valuation models to gain a comprehensive understanding of a company's intrinsic value. In conclusion, market valuation models such as the DCF model, CCA, and DDM are valuable tools for assessing the intrinsic value of a business. These models provide a systematic approach to estimate the worth of a company based on market factors and financial indicators. However, it is crucial to recognize the limitations of these models and use them in conjunction with other analysis techniques to make well-informed investment decisions. 4. Management and intrinsic value. 4.1 Role of management in determining intrinsic value. The intrinsic value of a business is a fundamental concept that plays a crucial role in determining the worth of a company. It represents the true value of a business based on its underlying assets, earnings potential, and future cash flows. While various factors contribute to the calculation of intrinsic value, the role of management cannot be overlooked. Effective management is essential in maximizing the intrinsic value of a business and ensuring its long-term success. 4.1.1 Leadership and Vision. Leadership is a key aspect of management that significantly influences the intrinsic value of a business. A strong and visionary leader can guide the company towards achieving its goals and objectives, which ultimately enhances its value. Effective leaders have the ability to inspire and motivate employees, fostering a positive work environment and encouraging innovation and growth. They set a clear direction for the company, making strategic decisions that align with the long-term vision and mission of the organization. Leadership also plays a vital role in managing risks and uncertainties. A competent leader anticipates potential challenges and develops strategies to mitigate them, safeguarding the intrinsic value of the business. By effectively managing risks, leaders can protect the company from potential financial losses and maintain its stability and growth. 4.1.2 Strategic Decision-Making. Management is responsible for making strategic decisions that impact the intrinsic value of a business. These decisions include capital allocation, investment choices, and resource allocation. Effective management evaluates various investment opportunities and allocates resources to projects that generate the highest returns and add value to the business. By making informed decisions, management can enhance the intrinsic value of the company by maximizing profitability and growth potential. Strategic decision-making also involves identifying and capitalizing on market opportunities. Management needs to stay abreast of market trends, customer preferences, and competitive dynamics to make informed decisions that drive the company's growth and profitability. By identifying and pursuing strategic opportunities, management can create a competitive advantage for the business, increasing its intrinsic value. 4.1.3 Operational Efficiency. Management plays a critical role in ensuring operational efficiency, which directly impacts the intrinsic value of a business. Efficient management of resources, processes, and systems can lead to cost savings, improved productivity, and increased profitability. By optimizing operations, management can enhance the intrinsic value of the business by generating higher cash flows and reducing expenses. Effective management also focuses on continuous improvement and innovation. By implementing efficient processes and adopting new technologies, management can streamline operations, enhance productivity, and drive growth. This not only improves the financial performance of the business but also enhances its competitive position, ultimately increasing its intrinsic value. 4.1.4 Corporate Governance. Corporate governance is another important aspect of management that influences the intrinsic value of a business. Good corporate governance practices ensure transparency, accountability, and ethical behavior within the organization. By adhering to strong governance principles, management can build trust and confidence among stakeholders, including investors, employees, and customers. Transparent and ethical practices enhance the reputation of the business, attracting investors and maintaining a positive relationship with stakeholders. This, in turn, can positively impact the intrinsic value of the company. Effective management ensures that the company operates in compliance with legal and regulatory requirements, minimizing the risk of legal issues and reputational damage. 4.1.5 Talent Management and Succession Planning. Management is responsible for attracting and retaining top talent within the organization. Skilled and motivated employees contribute to the overall success of the business and enhance its intrinsic value. Effective management focuses on talent management strategies, including recruitment, training, and development, to build a capable and high-performing workforce. Succession planning is another critical aspect of talent management. Management needs to identify and groom future leaders within the organization to ensure a smooth transition and continuity of operations. By developing a strong leadership pipeline, management can safeguard the intrinsic value of the business and maintain its long-term success. In conclusion, management plays a pivotal role in determining the intrinsic value of a business. Effective leadership, strategic decision-making, operational efficiency, corporate governance, and talent management are all crucial factors that contribute to the overall value of a company. By focusing on these areas, management can enhance the intrinsic value of the business, ensuring its long-term growth and success. 4.2 Leadership and its influence on intrinsic value. Leadership plays a crucial role in determining the intrinsic value of a business. Effective leadership can significantly impact the overall performance and success of an organization, ultimately influencing its intrinsic value. In this section, we will explore the various ways in which leadership influences intrinsic value and why it is essential for leaders to prioritize this aspect of their role. 4.2.1 Setting the vision and direction. One of the primary responsibilities of a leader is to set the vision and direction for the organization. By establishing a clear and compelling vision, leaders provide a sense of purpose and direction to their teams. This vision serves as a guiding force that aligns the efforts of employees towards a common goal. When the vision is well defined and communicated effectively, it fosters a sense of unity and motivation among employees, leading to increased productivity and ultimately enhancing the intrinsic value of the business. 4.2.2 Building a strong organizational culture. Leadership plays a critical role in shaping the organizational culture. A strong and positive culture can have a significant impact on the intrinsic value of a business. Leaders who prioritize creating a culture of trust, collaboration, and innovation foster an environment where employees feel valued and motivated. This, in turn, leads to higher employee engagement, productivity, and retention, all of which contribute to the overall intrinsic value of the organization. 4.2.3 Developing and empowering employees. Effective leaders understand the importance of developing and empowering their employees. They invest in training and development programs that enhance the skills and capabilities of their teams. By providing opportunities for growth and advancement, leaders not only increase the competency of their workforce but also foster a sense of loyalty and commitment. Empowered employees are more likely to take ownership of their work, contribute innovative ideas, and go the extra mile to achieve organizational goals. This, in turn, positively impacts the intrinsic value of the business. 4.2.4 Driving innovation and adaptability. In today's rapidly changing business landscape, innovation and adaptability are crucial for long-term success. Leaders who encourage a culture of innovation and embrace change are better positioned to drive growth and enhance the intrinsic value of their organizations. They promote a mindset that encourages experimentation, risk-taking, and learning from failures. By fostering a culture of innovation, leaders enable their teams to develop new products, services, and processes that can create a competitive advantage and increase the intrinsic value of the business. 4.2.5 Effective decision-making. Leadership is closely tied to decision-making processes within an organization. Effective leaders possess the ability to make informed and timely decisions that align with the overall strategic objectives of the business. Their decision-making skills impact various aspects of the organization, including resource allocation, risk management, and strategic investments. Well-informed decisions that consider the long-term implications can significantly enhance the intrinsic value of the business. 4.2.6 Building and maintaining stakeholder relationships. Leadership involves building and maintaining relationships with various stakeholders, including employees, customers, investors, and the community. Effective leaders understand the importance of these relationships and actively work towards building trust and credibility. By fostering positive relationships, leaders can attract and retain top talent, build a loyal customer base, and secure the support of investors. These strong stakeholder relationships contribute to the overall reputation and intrinsic value of the business. 4.2.7 Ethical leadership. Ethical leadership is crucial for the long-term success and intrinsic value of a business. Leaders who prioritize ethical behavior and integrity set the tone for the entire organization. They establish a culture of honesty, transparency, and accountability, which builds trust among stakeholders. Ethical leadership not only enhances the reputation of the business but also mitigates the risk of legal and ethical violations that can negatively impact the intrinsic value of the organization. 4.2.8 Leading through challenges. Leadership is tested during challenging times, such as economic downturns, industry disruptions, or crises. Effective leaders demonstrate resilience, adaptability, and the ability to navigate through uncertainty. They provide guidance, support, and reassurance to their teams, instilling confidence and maintaining focus on long-term goals. By leading through challenges, leaders can minimize the negative impact on the intrinsic value of the business and position it for future success. In conclusion, leadership plays a vital role in influencing the intrinsic value of a business. Effective leaders set the vision and direction, build a strong organizational culture, develop and empower employees, drive innovation and adaptability, make informed decisions, build and maintain stakeholder relationships, prioritize ethical behavior, and lead through challenges. By focusing on these aspects of leadership, organizations can enhance their intrinsic value and position themselves for long-term success. 4.3 Corporate governance and intrinsic value. Corporate governance plays a crucial role in determining the intrinsic value of a business. It encompasses the systems, processes, and practices by which a company is directed and controlled. Effective corporate governance ensures that the interests of shareholders, stakeholders, and the broader society are protected and aligned with the long-term value creation of the business. 4.3.1 Importance of corporate governance. Good corporate governance is essential for maintaining the trust and confidence of investors, as well as attracting new capital. It provides a framework for responsible decision-making, accountability, and transparency within an organization. By establishing clear roles and responsibilities, corporate governance helps to mitigate risks, prevent fraud, and ensure ethical behavior. 4.3.2 Board of Directors. The Board of Directors is a key component of corporate governance. It is responsible for overseeing the management of the company and making strategic decisions that impact its long-term value. The board should be composed of individuals with diverse backgrounds and expertise, who can provide independent oversight and challenge management when necessary. 4.3.3 Board Independence. Independence is a critical aspect of effective corporate governance. Independent directors bring objectivity and impartiality to the decision-making process. They are not influenced by personal or financial interests that may conflict with the best interests of the company and its shareholders. Independent directors act as a check and balance on management, ensuring that decisions are made in the best interest of the business. 4.3.4 Transparency and disclosure. Transparency and disclosure are fundamental principles of corporate governance. Companies should provide timely and accurate information to shareholders and stakeholders, enabling them to make informed decisions. Transparent reporting practices build trust and confidence in the business, while also allowing investors to assess the intrinsic value of the company. 4.3.5 Shareholder rights. Respecting and protecting the rights of shareholders is a key aspect of corporate governance. Shareholders should have the right to participate in decision-making, vote on important matters, and receive a fair return on their investment. Companies should establish mechanisms to facilitate shareholder engagement and ensure that their interests are represented. 4.3.6 Risk Management. Corporate governance plays a vital role in risk management. It involves identifying, assessing, and mitigating risks that could impact the intrinsic value of the business. Effective risk management practices help to protect the company from financial, operational, and reputational risks. By implementing robust risk management frameworks, companies can enhance their intrinsic value and safeguard the interests of shareholders. 4.3.7 Ethical Standards. Ethical behavior is a cornerstone of good corporate governance. Companies should establish a code of conduct and ethical standards that guide the behavior of employees and management. Upholding high ethical standards not only protects the reputation of the business but also contributes to the long-term intrinsic value by fostering trust and integrity. 4.3.8 Executive Compensation. Executive compensation is an important aspect of corporate governance. It should be aligned with the long-term interests of the company and its shareholders. Compensation packages should incentivize executives to create sustainable value and discourage excessive risk-taking. Transparent disclosure of executive compensation ensures accountability and helps shareholders assess the alignment between management's interests and the intrinsic value of the business. 4.3.9 Compliance and Legal Frameworks. Compliance with applicable laws and regulations is a fundamental requirement of corporate governance. Companies should establish robust compliance programs to ensure adherence to legal and regulatory requirements. Compliance not only mitigates legal and reputational risks but also contributes to the long-term intrinsic value by fostering a culture of integrity and accountability. 4.3.10 Stakeholder Engagement. Engaging with stakeholders is an integral part of corporate governance. Companies should identify and understand the needs and expectations of their stakeholders, including employees, customers, suppliers, and the broader community. By actively engaging with stakeholders, companies can build strong relationships, manage risks, and enhance their intrinsic value by aligning their business practices with the interests of all stakeholders. 4.3.11 International Standards and Best Practices. Many countries have established corporate governance codes and guidelines to promote best practices. These standards provide a framework for companies to enhance their corporate governance practices and improve their intrinsic value. Adhering to international standards and best practices not only ensures compliance but also demonstrates a commitment to responsible and sustainable business practices. In conclusion, corporate governance is a critical factor in determining the intrinsic value of a business. It establishes the framework for responsible decision-making, accountability, and transparency. By promoting good corporate governance practices, companies can enhance their intrinsic value, attract investment, and build trust with shareholders and stakeholders. Effective corporate governance is not only a legal and regulatory requirement but also a strategic imperative for long-term business success. 4.4 Management's impact on long-term intrinsic value. Management plays a crucial role in determining the long-term intrinsic value of a business. The decisions and actions taken by management can have a significant impact on the overall value of the company and its ability to generate sustainable growth. In this section, we will explore the various ways in which management influences the long-term intrinsic value of a business. 4.4.1 Strategic Planning and Execution. One of the key responsibilities of management is to develop and execute a strategic plan that aligns with the long-term goals and objectives of the business. A well-defined and effectively executed strategy can enhance the intrinsic value of a company by positioning it for growth and profitability. Management must carefully analyze market trends, competitive landscape, and customer needs to identify opportunities and develop strategies to capitalize on them. By making informed decisions about resource allocation, product development, market expansion, and operational efficiency, management can create value for the business and its stakeholders. Effective strategic planning and execution can lead to increased market share, improved profitability, and enhanced competitive advantage, all of which contribute to the long-term intrinsic value of the company. 4.4.2 Leadership and Talent Management. Leadership is another critical factor that influences the long-term intrinsic value of a business. Effective leaders inspire and motivate employees, foster a culture of innovation and collaboration, and drive the organization towards its strategic objectives. Strong leadership can create a positive work environment that attracts and retains top talent, which is essential for the long-term success of the business. Management must also focus on talent management, ensuring that the right people are in the right roles and that they have the necessary skills and capabilities to contribute to the company's growth and success. By investing in employee development, providing opportunities for career advancement, and fostering a culture of continuous learning, management can build a high-performing team that drives the long-term intrinsic value of the business. 4.4.3 Financial Management and Capital Allocation. Sound financial management is crucial for maximizing the long-term intrinsic value of a business. Management must effectively manage the company's financial resources, including cash flow, working capital, and capital structure. By maintaining a healthy balance sheet, optimizing the use of debt and equity financing, and managing costs and expenses, management can enhance the financial stability and profitability of the business. Furthermore, management plays a critical role in capital allocation decisions. They must carefully evaluate investment opportunities, considering factors such as potential returns, risk, and alignment with the company's strategic objectives. By allocating capital to projects and initiatives that generate the highest long-term intrinsic value, management can ensure that the business is on a sustainable growth trajectory. 4.4.4 Corporate Governance and Ethical Practices. Effective corporate governance is essential for maintaining the long-term intrinsic value of a business. Management must establish and adhere to strong governance practices that promote transparency, accountability, and ethical behavior. By implementing robust internal controls, conducting regular audits, and ensuring compliance with applicable laws and regulations, management can protect the interests of shareholders and stakeholders. Ethical practices are also crucial for preserving the long-term intrinsic value of a business. Management must prioritize integrity, honesty, and fairness in all business dealings. By building a reputation for ethical behavior, the company can enhance its brand value, attract investors, and maintain the trust and confidence of its stakeholders. 4.4.5 Innovation and Adaptability. In today's rapidly changing business environment, management must foster a culture of innovation and adaptability. By encouraging creativity, embracing new technologies, and continuously seeking opportunities for improvement, management can drive innovation and position the company for long-term success. Innovation can lead to the development of new products and services, improved operational efficiency, and enhanced customer experiences. By staying ahead of market trends and proactively adapting to changes, management can ensure that the business remains competitive and relevant, ultimately contributing to its long-term intrinsic value. 4.4.6 Stakeholder Engagement and Relationship Management. Management's ability to effectively engage with stakeholders and manage relationships is crucial for the long-term intrinsic value of a business. By understanding the needs and expectations of stakeholders, including customers, employees, suppliers, and investors, management can build strong relationships based on trust and mutual benefit. Effective stakeholder engagement can lead to increased customer loyalty, improved employee satisfaction, and enhanced supplier relationships. By actively managing these relationships and addressing stakeholder concerns, management can create a positive reputation and goodwill, which can contribute to the long-term intrinsic value of the business. In conclusion, management plays a vital role in determining the long-term intrinsic value of a business. Through strategic planning and execution, effective leadership, sound financial management, ethical practices, innovation, and stakeholder engagement, management can enhance the intrinsic value of the company and position it for sustainable growth. By making informed decisions and taking actions that align with the long-term goals and objectives of the business, management can create value for the company and its stakeholders, ultimately maximizing the long-term intrinsic value of the business. 5. Risk assessment and intrinsic value. 5.1 Types of business risks and their effect on intrinsic value. Intrinsic value is a fundamental concept in business valuation that represents the true worth of a company or an investment. It is the underlying value of a business based on its cash flows, assets, and potential for growth. However, the intrinsic value of a business is not static and can be influenced by various risks that a company faces in its operations. Understanding these risks and their impact on intrinsic value is crucial for investors and decision makers. 5.1.1 Market risk. Market risk refers to the potential for losses due to changes in market conditions, such as fluctuations in interest rates, exchange rates, or stock prices. These external factors can significantly affect the intrinsic value of a business. For example, a sudden increase in interest rates can lead to higher borrowing costs for a company, reducing its profitability and ultimately lowering its intrinsic value. Similarly, a decline in stock prices can negatively impact the value of a company, especially if it relies on equity financing or has significant investments in the stock market. 5.1.2 Financial risk. Financial risk relates to the company's ability to meet its financial obligations, such as debt repayments or interest payments. High levels of debt can increase the financial risk of a business, as it may struggle to generate sufficient cash flows to cover its obligations. This can lead to a decrease in the intrinsic value of the company, as investors may perceive it as a higher risk investment. Additionally, factors such as liquidity risk, credit risk, and operational risk can also contribute to the overall financial risk of a business and impact its intrinsic value. 5.1.3 Operational risk. Operational risk refers to the potential for losses arising from internal processes, systems, or human error within a company. These risks can include supply chain disruptions, product recalls, regulatory compliance issues, or even natural disasters. Operational risks can have a significant impact on a company's intrinsic value by affecting its revenue generation, cost structure, and overall profitability. For example, a manufacturing company that experiences frequent equipment breakdowns may face increased operational costs and reduced production capacity, leading to a decline in its intrinsic value. 5.1.4 Competitive risk. Competitive risk arises from the competitive dynamics within an industry or market. It includes factors such as the entry of new competitors, changes in consumer preferences, or the emergence of substitute products or services. These risks can impact a company's market share, pricing power, and overall profitability. A highly competitive market can erode a company's intrinsic value by putting pressure on its margins and limiting its growth prospects. On the other hand, a company with a strong competitive advantage may be better positioned to mitigate these risks and maintain or enhance its intrinsic value. 5.1.5 Legal and regulatory risk. Legal and regulatory risks arise from changes in laws, regulations, or government policies that affect a company's operations. These risks can include compliance with environmental regulations, labor laws, tax laws, or industry-specific regulations. Failure to comply with these regulations can result in fines, penalties, or legal disputes, which can have a significant impact on a company's financial performance and intrinsic value. Additionally, changes in regulations can also create uncertainties and additional costs for businesses, affecting their ability to generate sustainable cash flows and maintain their intrinsic value. 5.1.6 Reputational risk. Reputational risk refers to the potential damage to a company's reputation due to negative public perception, customer dissatisfaction, or unethical behavior. A tarnished reputation can lead to a loss of customer trust, decreased sales, and difficulties in attracting and retaining talented employees. Reputational risks can have a long-lasting impact on a company's intrinsic value, as it may take time and resources to rebuild trust and restore its reputation. Investors and stakeholders often consider a company's reputation when assessing its intrinsic value and future prospects. 5.1.7 Technological risk. Technological risk arises from the rapid pace of technological advancements and the potential disruption it can cause to existing business models. Companies that fail to adapt to technological changes may become obsolete or lose their competitive edge. Technological risks can impact a company's intrinsic value by affecting its ability to innovate, maintain operational efficiency, or meet changing customer demands. On the other hand, companies that embrace technological advancements and leverage them to their advantage may enhance their intrinsic value by gaining a competitive advantage and driving growth. Understanding the various types of business risks and their effect on intrinsic value is essential for investors, managers, and other stakeholders. By identifying and assessing these risks, businesses can develop strategies to mitigate their impact and protect their intrinsic value. Moreover, investors can make more informed decisions by considering the risks associated with a company and evaluating its intrinsic value in light of these risks. Ultimately, managing and minimizing risks is crucial for preserving and enhancing the intrinsic value of a business. 5.2 Risk management strategies for preserving intrinsic value. Risk management is a crucial aspect of preserving the intrinsic value of a business. Intrinsic value represents the true worth of a business, taking into account its underlying assets, cash flows, and potential for future growth. However, various risks can pose a threat to this value, potentially eroding it over time. Therefore, implementing effective risk management strategies is essential to safeguard and preserve the intrinsic value of a business. 5.2.1 Identifying and assessing risks. The first step in risk management is to identify and assess the potential risks that could impact the intrinsic value of a business. Risks can arise from various sources, including economic, market, political, regulatory, operational, and financial factors. It is crucial to conduct a comprehensive risk assessment to understand the nature and magnitude of these risks. To identify risks, businesses can use various techniques such as conducting risk workshops, analyzing historical data, and engaging with industry experts. Once the risks are identified, they need to be assessed in terms of their likelihood of occurrence and potential impact on the intrinsic value. This assessment helps prioritize risks and allocate resources effectively to manage them. 5.2.2 Developing risk mitigation strategies. After identifying and assessing risks, the next step is to develop risk mitigation strategies. These strategies aim to minimize the impact of risks on the intrinsic value of the business. Here are some common risk management strategies that businesses can employ. Diversification. Diversification is a strategy that involves spreading investments across different assets, industries, or geographical regions. By diversifying their operations or investments, businesses can reduce the impact of specific risks on their intrinsic value. For example, a company operating in multiple markets or offering a diverse range of products is less vulnerable to the risks associated with a single market or product. Insurance. Insurance is an essential risk management tool that helps businesses transfer the financial impact of certain risks to an insurance provider. By purchasing insurance policies, businesses can protect themselves against potential losses due to events such as property damage, liability claims, or business interruption. Insurance provides a safety net, allowing businesses to recover and preserve their intrinsic value in the face of unforeseen events. Risk avoidance. In some cases, the best strategy to preserve intrinsic value is to avoid certain risks altogether. This can involve refraining from engaging in high-risk activities or entering into partnerships with unreliable or financially unstable entities. By carefully evaluating potential risks and making informed decisions, businesses can proactively avoid risks that could jeopardize their intrinsic value. Risk transfer. Risk transfer involves shifting the responsibility for managing a specific risk to another party. This can be achieved through contracts, agreements, or outsourcing certain activities to specialized service providers. By transferring risks to parties better equipped to handle them, businesses can reduce their exposure and protect their intrinsic value. Risk monitoring and contingency planning. Risk management is an ongoing process that requires continuous monitoring and evaluation. Businesses should establish robust monitoring systems to detect changes in the risk landscape and promptly respond to emerging risks. Additionally, developing contingency plans for potential risk scenarios can help mitigate their impact on the intrinsic value. Contingency plans outline predefined actions and strategies to be implemented in the event of a risk materializing. 5.2.3 Integration of risk management into business strategy. To effectively preserve the intrinsic value of a business, risk management should be integrated into the overall business strategy. It should not be treated as a separate function but rather as an integral part of decision-making processes. By considering risk factors when formulating business strategies, companies can proactively address potential risks and protect their intrinsic value. Furthermore, risk management should be embedded in the organizational culture, with employees at all levels understanding the importance of identifying and managing risks. Regular training and communication on risk management practices can help create a risk-aware culture and ensure that risk management strategies are consistently applied throughout the organization. Conclusion. Preserving the intrinsic value of a business requires a proactive and comprehensive approach to risk management. By identifying and assessing risks, developing appropriate mitigation strategies, and integrating risk management into the business strategy, companies can effectively safeguard their intrinsic value. Risk management is an ongoing process that requires continuous monitoring and adaptation to changing risk landscapes. By implementing robust risk management strategies, businesses can protect their intrinsic value and enhance their long-term sustainability. 5.3 Economic and market risks and their impact on intrinsic value. Economic and market risks play a significant role in determining the intrinsic value of a business. These risks can have a profound impact on the financial performance and future prospects of a company, ultimately affecting its intrinsic value. In this section, we will explore the various economic and market risks that businesses face and understand how they influence the intrinsic value. 5.3.1 Economic risks. Economic risks refer to the uncertainties and challenges that arise from the overall state of the economy. These risks can stem from factors such as inflation, interest rates, economic growth, and government policies. Understanding and managing economic risks is crucial for businesses as they directly impact their profitability and growth potential. Inflation risk. Inflation is the general increase in prices of goods and services over time. It erodes the purchasing power of money and can have a detrimental effect on a company's profitability. When inflation rises, the cost of raw materials, labor, and other inputs increases, squeezing profit margins. This can lead to a decline in the intrinsic value of a business, as investors may perceive it as less attractive due to reduced profitability. Interest rate risk. Interest rates have a significant impact on the cost of borrowing and the return on investment. Changes in interest rates can affect a company's ability to finance its operations and investments. When interest rates rise, borrowing costs increase, which can reduce profitability and cash flow. This, in turn, can lower the intrinsic value of a business, as investors may demand a higher return to compensate for the increased risk. Economic growth risk. Economic growth is a crucial driver of business performance. When the economy is growing, businesses tend to thrive, leading to increased sales and profitability. However, during periods of economic downturn or recession, businesses face challenges such as reduced consumer spending, declining demand, and increased competition. These factors can negatively impact a company's financial performance and, consequently, its intrinsic value. Government policy risk. Government policies and regulations can significantly impact businesses across various industries. Changes in tax policies, trade regulations, environmental regulations, and labor laws can create uncertainties and additional costs for companies. Adapting to new policies and complying with regulations can be costly and time-consuming, affecting a company's profitability and intrinsic value. 5.3.2 Market risks. Market risks are associated with the volatility and unpredictability of financial markets. These risks can arise from factors such as stock market fluctuations, currency exchange rates, and investor sentiment. Understanding and managing market risks is crucial for businesses as they can have a direct impact on their stock prices and overall market perception. Stock market fluctuations. Stock market fluctuations can have a significant impact on a company's stock price and market capitalization. Factors such as investor sentiment, economic indicators, and geopolitical events can cause stock prices to rise or fall rapidly. These fluctuations can affect the perceived value of a business, as investors may adjust their expectations and valuations based on market trends. Currency exchange rate risk. For businesses operating in multiple countries or engaged in international trade, currency exchange rate risk is a crucial consideration. Fluctuations in exchange rates can impact a company's revenue, costs, and profitability. When the value of a company's domestic currency strengthens against foreign currencies, it can reduce the competitiveness of its exports and affect its intrinsic value. Investor sentiment. Investor sentiment refers to the overall attitude and perception of investors towards a particular company or the market as a whole. Positive investor sentiment can drive stock prices higher, while negative sentiment can lead to a decline in stock prices. Investor sentiment can be influenced by various factors, including economic conditions, industry trends, company performance, and market news. Changes in investor sentiment can impact the intrinsic value of a business, as it affects the demand and perceived attractiveness of its stock. 5.3.3 Impact on intrinsic value. Economic and market risks can have a direct impact on the intrinsic value of a business. These risks influence the financial performance, growth prospects, and overall market perception of a company, which are key factors in determining its intrinsic value. When economic risks such as inflation, interest rates, economic growth, and government policies are unfavorable, they can negatively affect a company's profitability, cash flow, and long-term sustainability. This can lead to a decline in the intrinsic value of the business, as investors may perceive it as riskier or less attractive. Similarly, market risks such as stock market fluctuations, currency exchange rate volatility, and investor sentiment can impact a company's stock price and market perception. These factors can influence the perceived value of a business, as investors adjust their expectations and valuations based on market trends. To mitigate the impact of economic and market risks on intrinsic value, businesses need to adopt effective risk management strategies. This includes closely monitoring economic indicators, staying informed about market trends, diversifying operations and investments, and maintaining a strong financial position. By proactively managing these risks, businesses can enhance their intrinsic value and improve their long-term prospects. In conclusion, economic and market risks have a significant impact on the intrinsic value of a business. Understanding and managing these risks is crucial for businesses to maintain their financial performance, attract investors, and maximize their intrinsic value. By effectively navigating economic and market uncertainties, businesses can position themselves for long-term success and create value for their stakeholders. 5.4 Political and regulatory risks and their influence on intrinsic value. Political and regulatory risks play a significant role in determining the intrinsic value of a business. These risks arise from changes in government policies, regulations, and political stability, which can have a profound impact on a company's operations, profitability, and long-term prospects. Understanding and managing these risks is crucial for investors and businesses alike, as they can directly influence the intrinsic value of a company. 5.4.1 Political risks and their impact on intrinsic value. Political risks refer to the uncertainties and potential adverse effects that arise from political decisions and actions. These risks can include changes in government leadership, shifts in political ideologies, geopolitical tensions, and policy changes that directly affect businesses. Political risks can have a significant impact on a company's intrinsic value in several ways. Firstly, changes in government policies and regulations can directly affect a company's operations and profitability. For example, new regulations may impose additional compliance costs, restrict market access, or introduce barriers to entry. These changes can increase operational costs, reduce revenue streams, and limit growth opportunities, ultimately impacting the intrinsic value of the business. Secondly, political instability and uncertainty can create an unfavorable business environment. Investors are often hesitant to invest in countries or regions with political instability, as it introduces a higher level of risk. This can lead to a decrease in foreign direct investment, limited access to capital, and a decline in business opportunities. As a result, the intrinsic value of businesses operating in politically unstable regions may be negatively affected. Furthermore, political risks can also impact a company's reputation and brand image. Negative political events or controversies can lead to public backlash, boycotts, or damage to the company's reputation. This can result in a loss of customer trust, decreased sales, and a decline in the perceived value of the business. Ultimately, these factors can influence the intrinsic value of the company. 5.4.2 Regulatory risks and their influence on intrinsic value. Regulatory risks refer to the uncertainties and potential adverse effects that arise from changes in regulations and compliance requirements. These risks can stem from new laws, industry-specific regulations, environmental regulations, labor laws, and other regulatory frameworks. Regulatory risks can have a significant impact on a company's intrinsic value in several ways. Firstly, regulatory changes can impose additional compliance costs on businesses. Compliance with new regulations often requires companies to invest in new systems, processes, and resources, which can increase operational expenses. These increased costs can reduce profitability and ultimately impact the intrinsic value of the business. Secondly, regulatory risks can lead to legal and reputational consequences. Non-compliance with regulations can result in fines, penalties, lawsuits, and damage to the company's reputation. Legal battles and negative publicity can have a detrimental effect on a company's financial performance and brand image, ultimately impacting its intrinsic value. Moreover, regulatory changes can also disrupt existing business models and industry dynamics. For example, new regulations may require companies to adopt environmentally friendly practices or invest in renewable energy sources. While these changes may be necessary for the greater good, they can also require significant investments and operational adjustments. Failure to adapt to these changes can result in a loss of market share, decreased competitiveness, and a decline in the intrinsic value of the business. 5.4.3 Managing political and regulatory risks. To mitigate the impact of political and regulatory risks on intrinsic value, businesses need to adopt effective risk management strategies. Here are some key considerations for managing these risks. Monitoring and analysis. Stay informed about political developments, policy changes, and regulatory updates that may affect the business. Regularly assess the potential impact of these changes on operations, profitability, and long-term prospects. Diversification. Diversify operations across different regions and markets to reduce exposure to political and regulatory risks in a single jurisdiction. This can help mitigate the impact of adverse events in one market by relying on the stability and growth of other markets. Engagement and advocacy. Engage with policymakers, industry associations, and other stakeholders to influence policy decisions and advocate for a favorable business environment. Participate in public consultations, provide feedback on proposed regulations, and contribute to the development of industry standards. Compliance and risk mitigation. Develop robust compliance programs to ensure adherence to existing regulations and anticipate future regulatory changes. Implement risk mitigation measures, such as contingency plans, insurance coverage, and legal support, to minimize the impact of political and regulatory risks. Scenario planning. Conduct scenario analysis to assess the potential impact of different political and regulatory scenarios on the business. This can help identify vulnerabilities, develop contingency plans, and make informed strategic decisions to protect and enhance intrinsic value. By effectively managing political and regulatory risks, businesses can minimize the negative impact on intrinsic value and position themselves for long-term success. It is essential to recognize that these risks are inherent in the business environment and require proactive and ongoing attention to ensure the preservation and enhancement of intrinsic value. 6. Valuation techniques for intrinsic value. 6.1 Discounted cash flow (DCF) analysis for intrinsic value. One of the most widely used and effective methods for determining the intrinsic value of a business is the discounted cash flow (DCF) analysis. This valuation technique takes into account the future cash flows generated by the business and discounts them back to their present value, providing investors with an estimate of the business's intrinsic worth. 6.1.1 Understanding the DCF analysis. The DCF analysis is based on the principle that the value of a business is derived from the cash flows it generates over its lifetime. By estimating the future cash flows and discounting them back to their present value, investors can assess whether the current market price of a business is overvalued or undervalued. To perform a DCF analysis, several key components need to be considered. Cash flow projections. The first step in a DCF analysis is to forecast the future cash flows of the business. This involves estimating the revenue growth, operating expenses, capital expenditures, and working capital requirements over a specific period, typically 5 to 10 years. Accurate and realistic projections are crucial for an accurate valuation. Discount rate. The discount rate, also known as the required rate of return, is used to calculate the present value of future cash flows. It represents the minimum rate of return that investors expect to earn from their investment. The discount rate takes into account the risk associated with the business and the opportunity cost of investing in alternative investments. Terminal value. The DCF analysis also considers the terminal value, which represents the value of the business beyond the projected cash flow period. The terminal value is usually calculated using a perpetuity formula or by applying a multiple to the projected cash flow in the final year. It captures the value of the business's future cash flows beyond the forecasted period. 6.1.2 Calculating intrinsic value using DCF analysis. Once the cash flow projections, discount rate, and terminal value are determined, the intrinsic value of the business can be calculated using the following steps. Estimate the future cash flows for the projected period. Determine the discount rate based on the risk profile of the business and the expected return of investors. Discount each projected cash flow back to its present value using the discount rate. Calculate the terminal value by applying a perpetuity formula or using a multiple of the final year's cash flow. Discount the terminal value back to its present value. Sum the present values of the projected cash flows and the terminal value to obtain the total intrinsic value of the business. The result of the DCF analysis provides investors with an estimate of the business's intrinsic value. If the calculated intrinsic value is higher than the current market price, the business may be considered undervalued and potentially a good investment opportunity. Conversely, if the intrinsic value is lower than the market price, the business may be overvalued, and investors should exercise caution. 6.1.3 Limitations of DCF analysis. While the DCF analysis is a widely used valuation method, it is important to recognize its limitations and potential pitfalls. Some of the key limitations include accuracy of projections. The accuracy of the cash flow projections is crucial for an accurate valuation. Small errors or unrealistic assumptions in the projections can significantly impact the calculated intrinsic value. It is essential to base the projections on reliable data and thorough analysis. Subjectivity of discount rate. The selection of an appropriate discount rate is subjective and can vary depending on the investor's risk appetite and market conditions. Different discount rates can lead to significantly different intrinsic value estimates. It is crucial to carefully consider the risk factors and use a reasonable discount rate. Sensitivity to terminal value. The terminal value is a significant component of the DCF analysis, and small changes in the terminal value assumptions can have a substantial impact on the calculated intrinsic value. It is important to use conservative and realistic assumptions when estimating the terminal value. Market volatility and uncertainty. DCF analysis assumes that the projected cash flows and discount rate remain constant over the forecasted period. However, market conditions can change, and future cash flows may be subject to volatility and uncertainty. It is important to regularly review and update the projections to reflect changing market dynamics. Despite these limitations, the DCF analysis remains a valuable tool for assessing the intrinsic value of a business. It provides investors with a systematic and comprehensive approach to evaluate investment opportunities and make informed decisions based on the estimated intrinsic value. By understanding the principles and considerations of the DCF analysis, investors can enhance their ability to identify undervalued businesses and potentially generate superior returns. 6.2 Relative valuation methods and their application to intrinsic value. Relative valuation methods are widely used in the financial industry to determine the intrinsic value of a business. These methods involve comparing the financial metrics and valuation multiples of a company to those of similar companies in the same industry or market. By analyzing the relative valuation of a business, investors and analysts can gain insights into its intrinsic value and make informed investment decisions. 6.2.1 Comparable company analysis. One commonly used relative valuation method is the comparable company analysis, CCA. This approach involves identifying a group of comparable companies that operate in the same industry and have similar business characteristics. The financial metrics and valuation multiples of these companies are then analyzed and compared to determine the intrinsic value of the target company. To perform a CCA, analysts typically consider various financial ratios and multiples such as price-to-earnings P/E ratio, price-to-sales P/S ratio, and enterprise value to EBITDA EV/EBITDA ratio. These ratios and multiples provide insights into the relative valuation of the target company compared to its peers. The CCA method requires careful selection of comparable companies that have similar growth prospects, risk profiles, and business models. It is important to consider factors such as industry dynamics, market conditions, and company-specific factors when selecting comparable companies for analysis. By comparing the valuation multiples of the target company to those of its peers, analysts can estimate its intrinsic value and assess its relative attractiveness as an investment opportunity. 6.2.2 Market multiples approach. Another commonly used relative valuation method is the market multiples approach. This approach involves analyzing the valuation multiples of the overall market or a specific market segment and applying them to the financial metrics of the target company. The market multiples can include price-to-earnings P/E ratio, price-to-sales P/S ratio, price-to-book P/B ratio, and dividend yield, among others. The market multiples approach assumes that the market is efficient and that the valuation multiples of comparable companies reflect the true intrinsic value of the target company. By applying the market multiples to the financial metrics of the target company, analysts can estimate its intrinsic value based on the market's perception of similar companies. However, it is important to note that the market multiples approach has limitations. Market multiples can be influenced by market sentiment, investor behavior, and macroeconomic factors, which may not always accurately reflect the intrinsic value of a company. Therefore, it is crucial to consider other factors and perform a comprehensive analysis when using this approach. 6.2.3 Advantages and limitations of relative valuation methods. Relative valuation methods offer several advantages in assessing the intrinsic value of a business. Firstly, they provide a benchmark for comparison by analyzing the financial metrics and valuation multiples of similar companies. This allows investors to gain insights into the relative attractiveness of the target company compared to its peers. Secondly, relative valuation methods are relatively straightforward and easy to understand. They do not require complex financial modeling or extensive data analysis, making them accessible to a wide range of investors and analysts. However, it is important to acknowledge the limitations of relative valuation methods. Firstly, the selection of comparable companies is subjective and can significantly impact the results. Different analysts may choose different sets of comparable companies, leading to variations in the estimated intrinsic value. Secondly, relative valuation methods heavily rely on the accuracy and reliability of the financial data and assumptions used in the analysis. Any errors or biases in the data can lead to inaccurate estimations of intrinsic value. Lastly, relative valuation methods do not consider the specific characteristics and unique aspects of the target company. They rely on the assumption that the market accurately values similar companies, which may not always be the case. Conclusion. Relative valuation methods play a crucial role in determining the intrinsic value of a business. By comparing the financial metrics and valuation multiples of a company to those of similar companies, investors and analysts can estimate its intrinsic value and make informed investment decisions. However, it is important to consider the limitations of relative valuation methods and perform a comprehensive analysis that incorporates other factors to ensure a more accurate estimation of intrinsic value. 6.3 Asset-based valuation approaches for determining intrinsic value. Asset-based valuation approaches are one of the methods used to determine the intrinsic value of a business. These approaches focus on assessing the value of a company's assets and liabilities to estimate its worth. By analyzing the tangible and intangible assets owned by a business, investors and analysts can gain insights into the underlying value of the company. 6.3.1 Tangible assets. Tangible assets are physical assets that have a measurable value and can be seen or touched. They include items such as buildings, land, machinery, equipment, and inventory. When valuing a business using asset-based approaches, the value of tangible assets is an essential consideration. To determine the value of tangible assets, various methods can be employed. One common approach is the book value method, which calculates the value of assets based on their historical cost minus accumulated depreciation. However, this method may not always reflect the true market value of the assets, especially if they have appreciated or depreciated significantly since their purchase. Another approach is the replacement cost method, which estimates the value of assets by determining the cost of replacing them with similar assets at current market prices. This method provides a more accurate reflection of the current value of tangible assets, as it considers the cost of acquiring new assets in the present market conditions. 6.3.2 Intangible assets. Intangible assets are non-physical assets that do not have a physical presence but hold value for a business. Examples of intangible assets include patents, trademarks, copyrights, brand value, customer relationships, and intellectual property. These assets can significantly contribute to a company's intrinsic value, as they often represent a competitive advantage and future earnings potential. Valuing intangible assets can be more challenging than valuing tangible assets due to their subjective nature. However, several methods can be used to estimate their worth. One approach is the cost approach, which calculates the value of intangible assets based on the cost of creating or acquiring them. This method is commonly used for patents or copyrights, where the cost of development or acquisition is a good indicator of their value. Another approach is the income approach, which estimates the value of intangible assets based on the income they generate. This method considers the future cash flows that the assets are expected to generate and discounts them to their present value. By assessing the expected future earnings attributable to intangible assets, investors can determine their contribution to the overall intrinsic value of the business. 6.3.3 Liabilities and net asset value. In addition to assessing the value of assets, asset-based valuation approaches also consider the liabilities of a business. Liabilities include debts, loans, and other financial obligations that the company owes. By subtracting the total liabilities from the total assets, analysts can calculate the net asset value (NAV) of the business. The net asset value represents the residual value of a company's assets after deducting its liabilities. It provides an indication of the intrinsic value of the business, as it represents the value that would be left for shareholders if all the assets were sold and the liabilities were paid off. Investors and analysts often compare the net asset value per share to the market price per share to assess whether a company is undervalued or overvalued. If the net asset value per share is higher than the market price per share, it may indicate that the company is undervalued and presents a potential investment opportunity. 6.3.4 Limitations of asset-based valuation approaches. While asset-based valuation approaches provide valuable insights into the intrinsic value of a business, they have certain limitations that should be considered. One limitation is that these approaches do not account for the future earning potential of a company. They focus primarily on the value of the assets and liabilities at a specific point in time, without considering the company's ability to generate future profits. Additionally, asset-based valuation approaches may not fully capture the value of intangible assets, such as brand value or customer relationships, which can be crucial drivers of a company's success. These intangible assets are often difficult to quantify and may not be adequately reflected in the balance sheet. Furthermore, asset-based valuation approaches do not consider market factors such as supply and demand dynamics, competitive landscape, or industry trends. These external factors can significantly impact a company's intrinsic value and should be taken into account when assessing its worth. Despite these limitations, asset-based valuation approaches provide a foundation for understanding the intrinsic value of a business. By considering the tangible and intangible assets, liabilities, and net asset value, investors and analysts can gain valuable insights into the underlying worth of a company. When used in conjunction with other valuation methods, asset-based approaches can contribute to a comprehensive assessment of a business's intrinsic value. 6.4 Real options analysis and its role in intrinsic value assessment. Real options analysis is a valuable tool in assessing the intrinsic value of a business. It provides a framework for evaluating the potential future opportunities and flexibility that a business possesses, which can significantly impact its overall value. In this section, we will explore the concept of real options analysis and its role in determining the intrinsic value of a business. 6.4.1 Understanding real options analysis. Real options analysis is a financial technique that applies option pricing theory to evaluate the value of investment opportunities. It recognizes that businesses often have the ability to make strategic decisions and take advantage of future opportunities, similar to the way options work in financial markets. These options can include the choice to expand operations, enter new markets, develop new products, or even abandon unprofitable projects. The key idea behind real options analysis is that these strategic decisions have value, just like financial options. By considering the potential upside and downside of these options, businesses can better assess their intrinsic value. Real options analysis takes into account the uncertainty and volatility of future events, allowing decision makers to make more informed choices. 6.4.2 Types of real options. Real options can take various forms, depending on the specific circumstances and opportunities available to a business. Some common types of real options include Expansion options. These options allow a business to expand its operations in response to favorable market conditions or increased demand. By investing in additional capacity or resources, the business can capture new opportunities and generate additional value. Abandonment options. Sometimes, businesses may need to consider abandoning a project or discontinuing a product line due to changing market conditions or unforeseen challenges. Abandonment options provide the flexibility to exit such ventures, minimizing potential losses and preserving value. Timing options. Timing options refer to the ability to delay or accelerate investment decisions based on market conditions. By carefully timing their investments, businesses can maximize their returns and minimize risks. Flexibility options. Flexibility options allow businesses to adapt and adjust their strategies in response to changing market dynamics. This can include the ability to switch production methods, change suppliers, or pivot to new business models. Switching options. Switching options involve the ability to switch between different projects or investment opportunities. This flexibility allows businesses to allocate resources to the most promising ventures, optimizing their intrinsic value. 6.4.3 Evaluating real options. To assess the value of real options, businesses use various quantitative and qualitative methods. These methods consider factors such as the probability of success, the potential upside and downside, the timing of the option, and the cost of exercising the option. Quantitative methods, such as decision tree analysis and Monte Carlo simulation, can help estimate the value of real options by modeling different scenarios and their associated probabilities. These techniques provide a structured approach to evaluate the potential outcomes and uncertainties involved in exercising the options. Qualitative methods, on the other hand, involve subjective assessments and expert judgment. They consider factors that are difficult to quantify, such as market trends, competitive dynamics, and management capabilities. These qualitative assessments provide valuable insights into the potential value of real options. 6.4.4 Incorporating real options analysis into intrinsic value assessment. Real options analysis complements traditional valuation methods by considering the future opportunities and flexibility that a business possesses. By incorporating real options analysis into the assessment of intrinsic value, businesses can gain a more comprehensive understanding of their potential value. When conducting an intrinsic value assessment, it is essential to consider both the tangible and intangible assets of a business. Real options analysis helps capture the value of intangible assets, such as growth potential, brand value, and strategic advantages. By quantifying the value of these intangible assets, businesses can make more informed investment decisions and better allocate their resources. Furthermore, real options analysis provides a framework for strategic decision-making. It helps businesses identify and evaluate the potential opportunities and risks associated with different courses of action. By considering the value of real options, businesses can make more optimal decisions that maximize their long-term intrinsic value. In conclusion, real options analysis plays a crucial role in assessing the intrinsic value of a business. By recognizing the value of future opportunities and flexibility, businesses can make more informed investment decisions and better allocate their resources. Real options analysis complements traditional valuation methods by considering the potential upside and downside of strategic decisions. By incorporating real options analysis into the assessment of intrinsic value, businesses can gain a more comprehensive understanding of their potential value and enhance their long-term success. 7. Intrinsic value and investment decisions. 7.1 Intrinsic value is a basis for investment decision-making. Intrinsic value plays a crucial role in investment decision-making. It serves as a fundamental concept that investors use to determine the true worth of a business or investment opportunity. By understanding the intrinsic value of a business, investors can make informed decisions about whether to invest, hold, or sell their assets. The concept of intrinsic value. Intrinsic value refers to the underlying worth of a business or investment, independent of its market price. It represents the true value of an asset based on its fundamental characteristics, such as its cash flow, earnings potential, growth prospects, and risk profile. Unlike market value, which can fluctuate based on market sentiment and external factors, intrinsic value focuses on the inherent qualities and potential of the investment. Factors influencing intrinsic value. Several factors influence the intrinsic value of a business. These factors include the company's financial performance, competitive position, industry dynamics, management quality, and overall economic conditions. Understanding these factors is essential for accurately assessing the intrinsic value of an investment opportunity. Financial performance. The financial performance of a business, including its revenue growth, profitability, and cash flow generation, directly impacts its intrinsic value. A company with consistent and robust financial performance is likely to have a higher intrinsic value compared to a company with unstable or declining financials. Competitive position. The competitive position of a business within its industry is a critical determinant of its intrinsic value. A company with a strong competitive advantage, such as unique products or services, a loyal customer base, or superior operational efficiency, is likely to have a higher intrinsic value. Industry dynamics. The industry in which a business operates also affects its intrinsic value. Industries with high growth potential, favorable market conditions, and limited competition tend to have higher intrinsic values. Conversely, industries facing challenges or disruption may have lower intrinsic values. Management quality. The quality of a company's management team significantly influences its intrinsic value. Competent and experienced management can drive growth, make effective strategic decisions, and navigate challenges successfully, thereby enhancing the intrinsic value of the business. Economic conditions. The overall economic conditions, including factors such as interest rates, inflation, and consumer sentiment, can impact the intrinsic value of a business. A strong economy with favorable conditions generally leads to higher intrinsic values, while a weak economy may result in lower intrinsic values. Importance of intrinsic value in investment decision-making. Intrinsic value serves as a crucial tool for investors in making informed investment decisions. By assessing the intrinsic value of a business, investors can determine whether an investment opportunity is undervalued, overvalued, or fairly priced. This assessment helps investors identify potential opportunities for generating returns and managing risks effectively. Investment decision-making. Intrinsic value provides a basis for investment decision-making by helping investors identify opportunities that offer a margin of safety. If the market price of an investment is significantly lower than its intrinsic value, it may present an attractive investment opportunity. Conversely, if the market price exceeds the intrinsic value, it may indicate an overvalued investment. Risk management. Understanding the intrinsic value of an investment also helps investors manage risks effectively. By assessing the fundamental worth of a business, investors can identify potential risks and uncertainties that may impact its intrinsic value. This knowledge allows investors to make informed decisions about risk mitigation and portfolio diversification. Long-term perspective. Intrinsic value analysis encourages investors to take a long-term perspective when making investment decisions. By focusing on the fundamental worth of a business rather than short-term market fluctuations, investors can identify investments with strong growth potential and sustainable value creation over time. Value investing. Intrinsic value is a core concept in value investing, a strategy popularized by renowned investors such as Warren Buffett. Value investors seek to identify undervalued investments by comparing the market price to the intrinsic value. This approach aims to capitalize on market inefficiencies and generate long-term returns. In summary, intrinsic value serves as a foundation for investment decision-making. By understanding the intrinsic value of a business, investors can assess its true worth, identify investment opportunities, manage risks effectively, and adopt a long-term perspective. Incorporating intrinsic value analysis into investment strategies can enhance the likelihood of making informed and successful investment decisions. 7.2 Value investing strategies and intrinsic value. Value investing is an investment strategy that focuses on identifying undervalued stocks or assets in the market. It is based on the principle that the intrinsic value of a business is not always reflected in its market price. By analyzing the fundamental factors that drive a company's value, value investors aim to find opportunities where the market price is lower than the intrinsic value, providing a potential for long-term capital appreciation. 7.2.1 The concept of intrinsic value in value investing. Intrinsic value, as discussed in previous chapters, represents the true worth of a business or asset. It is determined by evaluating the underlying fundamentals of the company, such as its financial performance, growth prospects, competitive advantage, and management quality. Value investors believe that the market price of a stock can deviate from its intrinsic value due to various factors, including market sentiment, short-term fluctuations, and investor behavior. Value investing strategies revolve around the idea of buying stocks or assets that are trading at a discount to their intrinsic value. This approach aims to capitalize on the market's tendency to overreact to short-term news or events, creating opportunities for patient investors to acquire quality assets at a favorable price. 7.2.2 Fundamental analysis in value investing. Fundamental analysis plays a crucial role in value investing strategies. It involves a detailed examination of a company's financial statements, including its balance sheet, income statement, and cash flow statement. By analyzing these financial metrics, value investors can assess the company's profitability, liquidity, debt levels, and overall financial health. In addition to financial statements, value investors also consider qualitative factors such as the company's competitive position, industry dynamics, and management quality. They evaluate the company's moat, which refers to its ability to maintain a competitive advantage over its peers. A strong moat can contribute to sustainable profitability and long-term value creation. 7.2.3 Margin of safety. One of the key principles of value investing is the concept of a margin of safety. This refers to the difference between the intrinsic value of a stock and its market price. By investing with a margin of safety, value investors aim to protect themselves against potential downside risks and market volatility. The margin of safety provides a cushion for unexpected events or unfavorable market conditions. It allows investors to withstand short-term fluctuations and provides a higher probability of achieving positive returns over the long term. Value investors typically look for stocks that offer a significant margin of safety, where the market price is considerably lower than the estimated intrinsic value. 7.2.4 Contrarian investing. Contrarian investing is closely associated with value investing strategies. It involves taking positions that are opposite to the prevailing market sentiment. Contrarian investors believe that market prices can deviate from the intrinsic value due to irrational behavior and herd mentality. Contrarian investors actively seek out opportunities where the market has overreacted to negative news or events, causing the stock price to decline significantly. They take advantage of these situations by buying when others are selling, with the expectation that the market will eventually recognize the true value of the stock. 7.2.5 Long-term perspective. Value investing is a long-term investment strategy that requires patience and discipline. Value investors focus on the underlying fundamentals of a business rather than short-term market fluctuations. They are willing to hold on to their investments for an extended period, allowing the market to recognize the true value of the stock. By taking a long-term perspective, value investors aim to benefit from the compounding effect of value creation over time. They understand that the market may not immediately reflect the intrinsic value of a stock, but believe that over the long term, the market will eventually align with the fundamentals of the business. 7.2.6 Diversification and risk management. Diversification is an important aspect of value investing. Value investors understand the importance of spreading their investments across different industries and asset classes to reduce risk. By diversifying their portfolio, they aim to minimize the impact of any individual stock or sector-specific risks. Risk management is also a key consideration in value investing strategies. Value investors carefully assess the downside risks associated with their investments and take steps to mitigate them. They conduct thorough research and analysis to ensure that the stocks they select have a favorable risk-reward profile. 7.2.7 Value investing and behavioral finance. Value investing strategies are closely linked to the field of behavioral finance. Behavioral finance recognizes that investor behavior is influenced by psychological biases and emotions, which can lead to irrational decision-making. Value investors take advantage of these biases by capitalizing on market inefficiencies caused by investor sentiment. By understanding the psychological factors that drive market behavior, value investors can identify opportunities where the market has mispriced a stock due to cognitive biases. They remain disciplined and objective in their investment approach, relying on fundamental analysis rather than succumbing to emotional reactions. 7.2.8 Conclusion. Value investing strategies revolve around the concept of intrinsic value and the belief that the market can misprice stocks in the short term. By conducting thorough fundamental analysis, seeking a margin of safety, and taking a long-term perspective, value investors aim to identify undervalued stocks with the potential for long-term capital appreciation. Diversification and risk management are essential components of value investing, as is an understanding of behavioral finance and investor psychology. 7.3 Growth investing and its relationship to intrinsic value. Growth investing is an investment strategy that focuses on investing in companies with high growth potential. It involves identifying companies that are expected to experience significant growth in their earnings, revenues, and market share over time. Growth investors believe that these companies will outperform the market and generate substantial returns for their shareholders. The concept of growth investing is closely related to the intrinsic value of a business. Intrinsic value represents the true worth of a company based on its underlying fundamentals, such as its earnings, cash flows, and assets. It is the estimated value of a business if all the relevant factors are taken into consideration. When it comes to growth investing, the intrinsic value of a company plays a crucial role in determining its investment potential. Growth investors seek to identify companies that have the potential to grow their intrinsic value over time. They look for companies that are expected to increase their earnings and cash flows at a faster rate than the overall market. The relationship between growth investing and intrinsic value can be understood in the following ways. 7.3.1 Growth is a driver of intrinsic value. Growth is a key driver of intrinsic value. When a company experiences significant growth in its earnings and cash flows, its intrinsic value tends to increase. This is because higher earnings and cash flows translate into higher future cash flows, which are a key component of intrinsic value calculations. Growth investors focus on identifying companies that have the potential to grow their earnings and cash flows at an above-average rate. They believe that companies with strong growth prospects will generate higher returns for their shareholders over the long term. 7.3.2 Assessing growth potential. To determine the growth potential of a company, growth investors analyze various factors such as industry trends, competitive advantages, market share, and management's ability to execute growth strategies. They also consider the company's historical growth rates and future growth projections. By assessing the growth potential of a company, growth investors can estimate its future earnings and cash flows. These estimates are then used to calculate the intrinsic value of the company. If the estimated intrinsic value is higher than the current market price, it indicates that the company may be undervalued and presents a potential investment opportunity. 7.3.3 Balancing growth and valuation. While growth investors focus on companies with high growth potential, they also consider the valuation of the company. Paying too high a price for a growth stock can diminish the potential returns. Therefore, growth investors seek to find a balance between the growth prospects of a company and its valuation. They analyze the price-to-earnings P/E ratio, price-to-sales P/S ratio, and other valuation metrics to assess whether a company's stock is trading at a reasonable price relative to its growth potential. If the valuation appears to be too high, growth investors may decide to wait for a more attractive entry point or look for alternative investment opportunities. 7.3.4 Long-term perspective. Growth investing is typically a long-term investment strategy. Growth investors are willing to hold on to their investments for an extended period, allowing the company's growth potential to materialize and the intrinsic value to increase. They understand that the growth of a company may not happen overnight and that it requires time for the company to execute its growth strategies and deliver sustainable results. By taking a long-term perspective, growth investors aim to capture the full potential of a company's growth and maximize their investment returns. 7.3.5 Risks and challenges. While growth investing can offer significant returns, it also comes with its own set of risks and challenges. Investing in growth stocks can be volatile, as the market may have high expectations for these companies, leading to price fluctuations. Additionally, there is always the risk that the company may not be able to deliver on its growth projections, which can result in a decline in the intrinsic value of the stock. Therefore, growth investors need to conduct thorough research and analysis to assess the risks associated with a company's growth potential. In conclusion, growth investing and intrinsic value are closely intertwined. Growth investors seek to identify companies with high growth potential, as reflected in their intrinsic value. By assessing a company's growth prospects and balancing it with valuation, growth investors aim to generate substantial returns over the long term. However, it is important to note that growth investing comes with its own set of risks, and thorough analysis is necessary to make informed investment decisions. 7.4 Intrinsic value and risk-adjusted return on investment. Intrinsic value is a fundamental concept in investment analysis that helps investors determine the true worth of a business or investment opportunity. It represents the underlying value of a business based on its cash flows, assets, and growth potential. However, when making investment decisions, it is crucial to consider not only the intrinsic value but also the risk associated with the investment. This is where the concept of risk-adjusted return on investment comes into play. 7.4.1 Understanding risk-adjusted return on investment. Risk-adjusted return on investment is a measure that takes into account the level of risk associated with an investment and adjusts the expected return accordingly. It helps investors evaluate the potential return of an investment relative to the amount of risk taken. By incorporating risk into the analysis, investors can make more informed decisions and assess whether the potential return justifies the level of risk involved. 7.4.2 The relationship between intrinsic value and risk. Intrinsic value and risk are closely intertwined when it comes to investment decisions. While intrinsic value provides an estimate of the true worth of a business, it does not consider the level of risk associated with achieving that value. Therefore, it is essential to assess the risk factors that could impact the investment's performance and adjust the expected return accordingly. The risk associated with an investment can arise from various sources, such as market volatility, economic conditions, industry-specific risks, and company-specific risks. These risks can affect the cash flows, profitability, and growth potential of a business, ultimately impacting its intrinsic value. Therefore, it is crucial to evaluate the risk factors and their potential impact on the investment's performance. 7.4.3 Evaluating risk-adjusted return on investment. To evaluate the risk-adjusted return on investment, investors use various techniques and metrics that consider both the potential return and the associated risk. One commonly used metric is the risk-adjusted discount rate, which adjusts the discount rate used in discounted cash flow (DCF) analysis to reflect the level of risk involved. The risk-adjusted discount rate takes into account the risk-free rate of return, the risk premium associated with the investment, and the beta coefficient, which measures the investment's sensitivity to market movements. By adjusting the discount rate, investors can incorporate the level of risk into the valuation process and calculate the present value of the investment's expected cash flows more accurately. Another approach to evaluating risk-adjusted return on investment is through the use of risk-adjusted performance measures, such as the Sharpe ratio or the Trainer ratio. These ratios compare the excess return of an investment to its risk, providing a measure of the investment's risk-adjusted performance. By considering both the return and the risk, investors can assess whether the investment is generating an adequate return given the level of risk taken. 7.4.4 Balancing intrinsic value and risk-adjusted return on investment. When making investment decisions, it is essential to strike a balance between the intrinsic value of a business and the risk-adjusted return on investment. While a business may have a high intrinsic value, it may also come with a higher level of risk. On the other hand, a business with a lower intrinsic value may present a lower level of risk. Investors need to evaluate the risk-return trade-off and determine whether the potential return justifies the level of risk involved. This requires a thorough analysis of the investment's risk factors, including market conditions, industry dynamics, competitive landscape, and company-specific risks. By considering these factors, investors can assess the risk-adjusted return on investment and make informed decisions. It is important to note that risk tolerance varies among investors. Some investors may be more risk-averse and prefer investments with lower risk, even if it means accepting a lower return. Others may be more risk-tolerant and willing to take on higher levels of risk for the potential of higher returns. Understanding one's risk tolerance and aligning it with the risk-adjusted return on investment is crucial in making investment decisions that are in line with one's financial goals and objectives. In conclusion, while intrinsic value provides a measure of the true worth of a business, it is essential to consider the associated risk when making investment decisions. Evaluating the risk-adjusted return on investment allows investors to assess whether the potential return justifies the level of risk involved. By striking a balance between intrinsic value and risk-adjusted return, investors can make informed decisions that align with their risk tolerance and financial objectives. 8. Intrinsic value and business performance. 8.1 Intrinsic value is a measure of business performance. Intrinsic value is a fundamental concept in the world of business and finance. It represents the true worth of a business, independent of its current market price. Understanding and accurately assessing the intrinsic value of a business is crucial for evaluating its performance and making informed investment decisions. 8.1.1 Defining intrinsic value. Intrinsic value can be defined as the present value of all future cash flows that a business is expected to generate. It is based on the underlying fundamentals of the business, such as its earnings potential, growth prospects, and risk profile. Unlike market value, which is determined by supply and demand dynamics in the market, intrinsic value focuses on the underlying economic value of the business. 8.1.2 Factors affecting intrinsic value. Several factors influence the intrinsic value of a business. These include its financial performance, competitive position, industry dynamics, management quality, and macroeconomic conditions. A business with strong financials, a sustainable competitive advantage, and a favorable industry outlook is likely to have a higher intrinsic value compared to its peers. 8.1.3 Methods of calculating intrinsic value. There are various methods used to calculate the intrinsic value of a business. Some commonly employed approaches include discounted cash flow (DCF) analysis, relative valuation methods, and asset-based valuation approaches. Each method has its own assumptions and limitations, and it is often recommended to use multiple methods to arrive at a more comprehensive assessment of intrinsic value. 8.1.4 Importance of intrinsic value in business decision-making. Intrinsic value serves as a critical benchmark for business decision-making. It provides a reference point for determining whether a business is overvalued or undervalued in the market. By comparing the intrinsic value with the market price, investors can identify potential investment opportunities or avoid overpaying for a business. Intrinsic value also helps businesses evaluate their performance and set realistic financial goals. 8.1.5 Intrinsic value and financial performance. Intrinsic value is closely linked to a business's financial performance. A business that consistently generates strong earnings, maintains healthy profit margins, and effectively manages its resources is likely to have a higher intrinsic value. Financial performance indicators such as revenue growth, profitability ratios, and return on investment are key factors in determining the intrinsic value of a business. 8.1.6 Intrinsic value and operational efficiency. Operational efficiency plays a crucial role in determining a business's intrinsic value. Efficiently managed businesses are able to generate higher profits and cash flows, leading to an increase in their intrinsic value. By optimizing processes, reducing costs, and improving productivity, businesses can enhance their operational efficiency and subsequently improve their intrinsic value. 8.1.7 Intrinsic value and competitive advantage. A sustainable competitive advantage is a significant driver of a business's intrinsic value. Businesses that possess unique strengths, such as proprietary technology, strong brand recognition, or a loyal customer base, are more likely to maintain a competitive edge and generate higher profits over the long term. This, in turn, increases their intrinsic value. 8.1.8 Intrinsic value and sustainable growth. Sustainable growth is another important factor in determining a business's intrinsic value. Businesses that can consistently grow their revenues and earnings without compromising their profitability or financial stability are considered to have sustainable growth. Investors value businesses with sustainable growth higher, as it indicates the potential for long-term value creation and higher intrinsic value. 8.1.9 Intrinsic value and business performance evaluation. Intrinsic value serves as a valuable tool for evaluating a business's performance over time. By comparing the intrinsic value at different points in time, businesses can assess whether they have been able to create value for their shareholders. It also helps businesses identify areas for improvement and develop strategies to enhance their intrinsic value. 8.1.10 Conclusion. Intrinsic value is a critical measure of business performance and worth. It provides a comprehensive assessment of a business's financial performance, operational efficiency, competitive advantage, and growth prospects. By understanding and accurately assessing intrinsic value, businesses can make informed decisions, set realistic financial goals, and create long-term value for their stakeholders. Investors can also utilize intrinsic value to identify investment opportunities and make sound investment decisions. 8.2 Improving intrinsic value through operational efficiency. Operational efficiency plays a crucial role in enhancing the intrinsic value of a business. By optimizing processes, reducing costs, and maximizing productivity, companies can improve their overall performance and increase their intrinsic value. In this section, we will explore the various strategies and techniques that businesses can employ to enhance their operational efficiency and ultimately improve their intrinsic value. 8.2.1 Streamlining processes. One of the key ways to improve operational efficiency is by streamlining processes. This involves identifying and eliminating any unnecessary steps or bottlenecks that may hinder productivity. By mapping out the entire workflow and analyzing each step, businesses can identify areas for improvement and implement changes to streamline operations. Automation is a powerful tool that can significantly enhance operational efficiency. By automating repetitive tasks and utilizing technology to streamline processes, businesses can reduce human error, save time, and increase productivity. This can be achieved through the implementation of software systems, robotics, and artificial intelligence, among other technologies. 8.2.2 Effective resource management. Efficient resource management is another critical factor in improving intrinsic value. By effectively managing resources such as raw materials, inventory, and human capital, businesses can minimize waste, reduce costs, and optimize productivity. Inventory management is a crucial aspect of resource management. By implementing inventory control systems and adopting just-in-time (JIT) inventory management practices, businesses can reduce carrying costs, minimize stockouts, and improve cash flow. This not only enhances operational efficiency but also contributes to the overall financial health of the business. Human capital is a valuable resource that should be effectively managed to improve operational efficiency. This involves hiring the right people, providing them with adequate training and development opportunities, and fostering a culture of continuous improvement. By investing in their employees, businesses can enhance productivity, reduce turnover, and ultimately improve their intrinsic value. 8.2.3 Continuous process improvement. Continuous process improvement is a mindset that focuses on constantly evaluating and enhancing processes to achieve better results. By implementing methodologies such as Lean Six Sigma or Kaizen, businesses can identify areas for improvement, eliminate waste, and optimize operations. Regular performance monitoring and data analysis are essential components of continuous process improvement. By collecting and analyzing data on key performance indicators, KPIs, businesses can identify trends, pinpoint areas of inefficiency, and make data-driven decisions to improve operational processes. This can lead to increased productivity, reduced costs, and improved overall performance. 8.2.4 Supply chain optimization. Optimizing the supply chain is crucial for improving operational efficiency and enhancing intrinsic value. By collaborating with suppliers, implementing efficient logistics systems, and adopting lean supply chain practices, businesses can reduce lead times, minimize inventory holding costs, and improve customer satisfaction. Collaboration with suppliers is essential for ensuring a smooth and efficient supply chain. By establishing strong relationships, businesses can negotiate favorable terms, improve communication, and reduce the risk of disruptions. This can lead to cost savings, improved product quality, and enhanced overall operational efficiency. Implementing efficient logistics systems, such as just-in-time delivery and cross-docking, can significantly improve supply chain efficiency. By reducing transportation and storage costs, businesses can improve cash flow, minimize waste, and enhance overall operational efficiency. 8.2.5 Technology integration. Integrating technology into business operations is crucial for improving operational efficiency and increasing intrinsic value. By leveraging technology solutions such as enterprise resource planning (ERP) systems, customer relationship management (CRM) software, and data analytics tools, businesses can streamline processes, improve decision-making, and enhance overall performance. ERP systems provide businesses with a centralized platform for managing various aspects of their operations, including finance, inventory, and production. By integrating different functions and automating processes, businesses can improve efficiency, reduce costs, and enhance overall operational performance. CRM software enables businesses to effectively manage customer relationships, improve sales processes, and enhance customer satisfaction. By leveraging customer data and analytics, businesses can personalize marketing efforts, identify sales opportunities, and improve overall customer experience. Data analytics tools allow businesses to analyze large volumes of data to gain valuable insights and make informed decisions. By leveraging data analytics, businesses can identify trends, optimize processes, and improve overall operational efficiency. 8.2.6 Employee engagement and empowerment. Engaging and empowering employees is crucial for improving operational efficiency and increasing intrinsic value. By fostering a culture of collaboration, providing opportunities for growth and development, and recognizing and rewarding performance, businesses can enhance employee motivation, productivity, and overall performance. Effective communication is key to engaging employees and aligning them with the business's goals and objectives. By providing clear and transparent communication channels, businesses can ensure that employees understand their roles and responsibilities, feel valued, and are motivated to contribute to the organization's success. Empowering employees by delegating decision-making authority and providing them with the necessary tools and resources can significantly improve operational efficiency. By encouraging employees to take ownership of their work and providing them with opportunities to contribute ideas and suggestions, businesses can tap into their full potential and drive continuous improvement. In conclusion, improving operational efficiency is essential for enhancing the intrinsic value of a business. By streamlining processes, effectively managing resources, implementing continuous process improvement, optimizing the supply chain, integrating technology, and engaging and empowering employees, businesses can improve their overall performance and increase their intrinsic value. These strategies and techniques not only enhance operational efficiency but also contribute to the long-term success and sustainability of the business. 8.3 Intrinsic Value and Competitive Advantage. Competitive advantage is a crucial factor in determining the intrinsic value of a business. It plays a significant role in shaping the long-term success and profitability of a company. In this section, we will explore the relationship between intrinsic value and competitive advantage, and how businesses can leverage their competitive advantages to enhance their intrinsic value. 8.3.1 Understanding competitive advantage. Competitive advantage refers to the unique set of strengths and capabilities that a company possesses, enabling it to outperform its competitors and achieve superior financial performance. It is the distinctive edge that sets a business apart in the marketplace and allows it to create value for its customers and stakeholders. There are two primary types of competitive advantage: cost advantage and differentiation advantage. Cost advantage is achieved when a company can produce goods or services at a lower cost than its competitors, allowing it to offer competitive prices while maintaining profitability. Differentiation advantage, on the other hand, is attained when a company offers unique and superior products or services that are valued by customers, allowing it to command premium prices. 8.3.2 Competitive advantage and intrinsic value. Competitive advantage directly impacts the intrinsic value of a business. A company with a sustainable competitive advantage is more likely to generate higher profits and cash flows over the long term, which in turn increases its intrinsic value. Investors are willing to pay a premium for businesses with strong competitive advantages, as they offer greater potential for future growth and profitability. When assessing the intrinsic value of a business, it is essential to consider the durability and strength of its competitive advantage. A temporary or weak competitive advantage may not significantly impact the intrinsic value, as it can be easily replicated or eroded by competitors. However, a sustainable and robust competitive advantage can create a significant barrier to entry, making it difficult for competitors to replicate or surpass the company's performance. 8.3.3 Sources of competitive advantage. Competitive advantages can arise from various sources within a business. Some common sources of competitive advantage include 8.3.3.1 Intellectual property. Intellectual property, such as patents, trademarks, copyrights, and trade secrets, can provide a significant competitive advantage. These legal protections grant exclusive rights to the company, preventing others from using or replicating its innovations, products, or brand identity. Intellectual property can create a strong barrier to entry, allowing the company to maintain its market position and command premium prices. 8.3.3.2 Brand reputation. A strong brand reputation can be a powerful competitive advantage. Brands that are well-known, trusted, and associated with quality and reliability can attract loyal customers and command higher prices. Building a strong brand requires consistent delivery of superior products or services, effective marketing and communication strategies, and a focus on customer satisfaction. 8.3.3.3 Economies of scale. Economies of scale occur when a company can produce goods or services at a lower cost per unit as it increases its production volume. This cost advantage can be a significant competitive advantage, allowing the company to offer lower prices or higher profit margins compared to its competitors. Achieving economies of scale often requires substantial investments in production facilities, technology, and distribution networks. 8.3.3.4 Technological innovation. Technological innovation can provide a competitive advantage by enabling companies to develop new products, improve existing ones, or enhance operational efficiency. Companies that invest in research and development and stay at the forefront of technological advancements can gain a significant edge over their competitors. Technological innovation can lead to product differentiation, cost savings, and improved customer experiences. 8.3.3.5 Supply chain management. Efficient supply chain management can be a source of competitive advantage. Companies that can effectively manage their suppliers, optimize inventory levels, and streamline logistics can reduce costs, improve product availability, and enhance customer satisfaction. A well-designed and agile supply chain can provide a competitive edge by enabling faster response times, lower costs, and better overall operational performance. 8.3.4 Leveraging competitive advantage to enhance intrinsic value. To enhance the intrinsic value of a business, it is crucial to leverage and strengthen its competitive advantages. Here are some strategies that businesses can employ. 8.3.4.1 Continuous innovation. Continuously investing in research and development and fostering a culture of innovation can help businesses stay ahead of the competition. By developing new products, improving existing ones, and finding innovative solutions to customer needs, companies can maintain their differentiation advantage and attract a loyal customer base. Continuous innovation also allows businesses to adapt to changing market dynamics and seize new opportunities. 8.3.4.2 Building strong relationships. Developing strong relationships with customers, suppliers, and other stakeholders can provide a competitive advantage. By understanding and meeting the needs of customers, businesses can build loyalty and maintain a competitive edge. Collaborating closely with suppliers can ensure a reliable and cost-effective supply chain. Building strong relationships with other stakeholders, such as employees and communities, can enhance the company's reputation and create a positive brand image. 8.3.4.3 Operational Excellence. Achieving operational excellence is essential for maintaining a cost advantage. By continuously improving operational processes, reducing waste, and optimizing efficiency, businesses can lower their production costs and offer competitive prices. Operational excellence also enables companies to deliver products or services with consistent quality and reliability, enhancing their brand reputation and customer satisfaction. 8.3.4.4 Strategic Partnerships and Alliances. Forming strategic partnerships and alliances can help businesses leverage their competitive advantages and expand their market reach. Collaborating with complementary businesses or industry leaders can provide access to new markets, technologies, or distribution channels. Strategic partnerships can also enhance a company's brand reputation and credibility, attracting more customers and increasing its competitive advantage. In conclusion, competitive advantage is a critical factor in determining the intrinsic value of a business. Companies with sustainable and robust competitive advantages are more likely to generate higher profits and cash flows, leading to increased intrinsic value. By understanding and leveraging their competitive advantages, businesses can enhance their intrinsic value and position themselves for long-term success in the marketplace. 8.4 Intrinsic Value and Sustainable Growth. Sustainable growth is a crucial aspect of business success, and it plays a significant role in determining the intrinsic value of a company. Intrinsic value represents the true worth of a business, taking into account its future cash flows, profitability, and growth potential. It is a measure of the company's underlying value, independent of market fluctuations or short-term performance. 8.4.1 Understanding Sustainable Growth. Sustainable growth refers to the ability of a company to grow its operations and profitability over the long term while maintaining its financial health and stability. It is a delicate balance between expansion and maintaining the necessary resources to support that growth. Sustainable growth is essential because it ensures that a company can continue to create value for its shareholders and stakeholders while minimizing risks and maintaining a competitive advantage. 8.4.2 Factors influencing sustainable growth. Several factors influence the sustainable growth of a business. These factors include 8.4.2.1 Market demand and industry trends. The growth potential of a company is closely tied to the demand for its products or services in the market. Understanding market trends, consumer preferences, and industry dynamics is crucial for sustainable growth. By identifying emerging opportunities and adapting to changing market conditions, businesses can position themselves for long-term success. 8.4.2.2 Operational efficiency and productivity. Efficient operations and high productivity are essential for sustainable growth. By optimizing processes, reducing costs, and improving productivity, companies can generate higher profits and reinvest in their growth initiatives. Streamlining operations also allows businesses to scale their operations effectively and meet increasing customer demands. 8.4.2.3 Innovation and adaptability. Innovation and adaptability are key drivers of sustainable growth. Companies that continuously innovate and adapt to market changes can stay ahead of the competition and seize new opportunities. By investing in research and development, fostering a culture of innovation, and embracing new technologies, businesses can enhance their competitive advantage and drive sustainable growth. 8.4.2.4 Financial stability and capital allocation. Maintaining a strong financial position is crucial for sustainable growth. Companies need access to capital to fund their growth initiatives, whether through internal resources or external financing. Effective capital allocation, including prudent debt management and strategic investments, is essential to support sustainable growth without compromising financial stability. 8.4.3 Measuring sustainable growth. Measuring sustainable growth requires a comprehensive analysis of various financial and non-financial factors. Some key metrics and methods used to assess sustainable growth include 8.4.3.1 Revenue growth rate. The revenue growth rate measures the increase in a company's sales over a specific period. Sustainable growth requires consistent revenue growth, which can be achieved through market expansion, product diversification, or increased market share. A steady and predictable revenue growth rate is indicative of a company's ability to sustain its operations and generate value over the long term. 8.4.3.2 Return on investment (ROI). ROI measures the profitability of an investment relative to its cost. Sustainable growth requires a positive and increasing ROI, indicating that the company is generating higher returns on its investments. By effectively utilizing its resources and generating profitable returns, a company can reinvest in its operations and drive sustainable growth. 8.4.3.3 Cash flow generation. Cash flow generation is a critical factor in sustainable growth. Positive cash flow allows a company to fund its operations, invest in growth initiatives, and service its debt obligations. Sustainable growth requires consistent and positive cash flow from operations, indicating that the company can generate sufficient funds to support its growth plans. 8.4.3.4 Customer retention and satisfaction. Customer retention and satisfaction are vital for sustainable growth. By focusing on building strong customer relationships, delivering high-quality products or services, and providing excellent customer service, companies can retain their existing customers and attract new ones. Satisfied customers are more likely to become repeat customers and advocates for the company, contributing to its long-term growth. 8.4.4 Strategies for Achieving Sustainable Growth. To achieve sustainable growth, companies can adopt various strategies tailored to their specific industry and market conditions. Some effective strategies include 8.4.4.1 Market Expansion. Expanding into new markets can provide opportunities for sustainable growth. By identifying untapped markets or expanding geographically, companies can reach new customers and increase their market share. Market expansion strategies may involve product diversification, strategic partnerships, or acquisitions to gain a competitive advantage. 8.4.4.2 Product Innovation and Differentiation. Investing in product innovation and differentiation can drive sustainable growth. By continuously improving existing products or introducing new ones that meet customer needs, companies can stay ahead of the competition and attract a larger customer base. Innovation can also lead to higher profit margins and increased market share. 8.4.4.3 Strategic Partnerships and Alliances. Forming strategic partnerships and alliances can accelerate sustainable growth. By collaborating with complementary businesses, companies can leverage each other's strengths, access new markets, and share resources. Strategic partnerships can also facilitate knowledge transfer, technology sharing, and cost sharing, enabling companies to achieve sustainable growth more efficiently. 8.4.4.4 Talent Development and Retention. Investing in talent development and retention is crucial for sustainable growth. By attracting and retaining skilled employees, companies can build a strong workforce capable of driving innovation and achieving business objectives. Employee development programs, competitive compensation packages, and a positive work culture can contribute to talent retention and sustainable growth. Conclusion. Intrinsic value and sustainable growth are closely intertwined. Sustainable growth is a key driver of a company's intrinsic value, as it reflects the company's ability to generate long-term value for its shareholders and stakeholders. By understanding the factors influencing sustainable growth, measuring it effectively, and implementing appropriate strategies, businesses can enhance their intrinsic value and position themselves for long-term success. 9. Intrinsic value and capital structure. 9.1 Debt and equity financing and their impact on intrinsic value. Debt and equity financing are two common methods used by businesses to raise capital for their operations and growth. Both forms of financing have a significant impact on the intrinsic value of a business. In this section, we will explore how debt and equity financing affect the intrinsic value of a company and the considerations that business owners and investors should keep in mind. 9.1.1 Debt financing and intrinsic value. Debt financing involves borrowing money from external sources, such as banks or bondholders, with the promise to repay the principal amount along with interest over a specified period. When a company takes on debt, it increases its financial leverage, which can have both positive and negative effects on its intrinsic value. One of the main advantages of debt financing is that it allows businesses to access capital without diluting ownership. By borrowing funds, companies can maintain control and ownership over their operations while using the borrowed money to invest in growth opportunities. This can potentially increase the intrinsic value of the business if the investments generate higher returns than the cost of borrowing. However, debt financing also introduces financial risk to the business. The interest payments and principal repayments associated with debt can place a strain on the company's cash flow, especially if the business experiences a downturn or faces challenges in generating sufficient revenue. If the company fails to meet its debt obligations, it may lead to financial distress, which can significantly reduce the intrinsic value of the business. Furthermore, excessive debt levels can increase the cost of capital for the company. Lenders and investors may perceive a highly leveraged company as riskier, demanding higher interest rates or requiring additional collateral. This higher cost of capital can negatively impact the intrinsic value of the business by reducing its profitability and limiting its ability to invest in growth opportunities. 9.1.2 Equity financing and intrinsic value. Equity financing, on the other hand, involves raising capital by selling ownership shares in the company to investors. When a business issues equity, it dilutes existing shareholders' ownership but also provides an opportunity to raise funds without incurring debt. The impact of equity financing on intrinsic value depends on various factors. One advantage of equity financing is that it does not require regular interest or principal payments like debt financing. This can provide more flexibility to the business in managing its cash flow and reduce the risk of financial distress. Additionally, equity financing can bring in new investors who may contribute not only capital but also expertise and networks, which can enhance the intrinsic value of the business. However, equity financing also has its drawbacks. When a company issues new shares, it dilutes the ownership stake of existing shareholders. This dilution can reduce the intrinsic value per share, as the ownership of the company is spread among a larger number of shareholders. Existing shareholders may perceive this dilution negatively and may require a higher return on their investment to compensate for the reduced ownership. Furthermore, equity financing can lead to changes in control and decision-making within the company. New shareholders may have different objectives and priorities, which can impact the strategic direction of the business. This change in control can affect the intrinsic value of the company, especially if there is a divergence between the interests of existing and new shareholders. 9.1.3 Finding the optimal capital structure. Determining the optimal capital structure for a business is crucial for maximizing its intrinsic value. The capital structure refers to the mix of debt and equity financing that a company utilizes. Finding the right balance between debt and equity is essential to ensure the long-term sustainability and growth of the business. The optimal capital structure varies depending on factors such as the industry, business risk profile, and growth opportunities. Some industries, such as utilities or stable cash flow businesses, may be better suited for higher levels of debt financing due to their predictable revenue streams. On the other hand, industries with higher volatility or growth potential may require a more conservative approach with lower levels of debt. Finding the optimal capital structure involves considering the cost of capital, risk tolerance, and the impact on the intrinsic value of the business. A highly leveraged company may have a lower cost of debt but also higher financial risk, which can negatively impact the intrinsic value. Conversely, a company with a conservative capital structure may have a higher cost of capital but lower financial risk, potentially enhancing the intrinsic value. Business owners and investors should carefully evaluate the impact of debt and equity financing on the intrinsic value of the business. It is essential to assess the company's ability to service its debt obligations, the cost of capital, and the potential dilution of ownership. By finding the right balance between debt and equity financing, businesses can optimize their intrinsic value and position themselves for long-term success. 9.2 Optimal capital structure and intrinsic value maximization. In the pursuit of maximizing intrinsic value, businesses must carefully consider their capital structure. The capital structure refers to the mix of debt and equity financing that a company utilizes to fund its operations and investments. Achieving an optimal capital structure is crucial for businesses as it directly impacts their ability to generate value for shareholders and stakeholders. 9.2.1 Understanding capital structure. Capital structure decisions involve determining the proportion of debt and equity that a company should employ to finance its activities. Debt financing involves borrowing funds from external sources, such as banks or bondholders, while equity financing involves raising capital by issuing shares to investors. Each form of financing has its advantages and disadvantages, and finding the right balance is essential for maximizing intrinsic value. 9.2.2 The trade-off theory of capital structure. The trade-off theory of capital structure suggests that there is an optimal level of debt and equity that a company should maintain to maximize its intrinsic value. According to this theory, businesses must strike a balance between the benefits and costs associated with debt and equity financing. Debt financing offers several advantages. Firstly, interest payments on debt are tax-deductible, reducing the overall tax burden of the company. Secondly, debt allows businesses to leverage their operations, potentially increasing their return on investment. However, excessive debt can also increase financial risk and the cost of borrowing, which can negatively impact intrinsic value. Equity financing, on the other hand, provides businesses with the advantage of not having to make regular interest payments. Additionally, equity investors bear the risk of the business, which can help reduce financial distress. However, issuing additional equity dilutes existing shareholders' ownership and can lead to a decrease in intrinsic value. 9.2.3 Factors influencing optimal capital structure. Several factors influence the determination of an optimal capital structure for a business. These factors include 9.2.3.1 Business risk. The level of business risk plays a significant role in determining the optimal capital structure. Businesses operating in volatile industries or facing uncertain market conditions may prefer a lower level of debt to mitigate financial risk. Conversely, companies with stable cash flows and predictable earnings may be more comfortable taking on higher levels of debt. 9.2.3.2 Cost of capital. The cost of capital is another crucial factor in capital structure decisions. The cost of debt is typically lower than the cost of equity due to the tax advantages associated with interest payments. However, as the level of debt increases, lenders may demand higher interest rates, increasing the cost of debt. Balancing the cost of debt and equity is essential to optimize the overall cost of capital. 9.2.3.3 Growth opportunities. The growth prospects of a business also influence its optimal capital structure. Companies with significant growth opportunities may choose to finance their expansion through equity financing to avoid the burden of interest payments. Conversely, businesses with limited growth prospects may rely more on debt financing to take advantage of tax benefits and leverage. 9.2.3.4 Industry norms. Industry norms and standards can also impact a company's capital structure decisions. Companies often benchmark their capital structure against industry peers to ensure they remain competitive and attractive to investors. Deviating significantly from industry norms may raise concerns among investors and affect the company's intrinsic value. 9.2.4 Maximizing intrinsic value through optimal capital structure. Finding the optimal capital structure is a delicate balancing act that requires careful consideration of various factors. By achieving the right mix of debt and equity financing, businesses can maximize their intrinsic value in several ways. 9.2.4.1 Cost of capital reduction. Optimizing the capital structure can help reduce the overall cost of capital for a business. By minimizing the cost of debt and equity, companies can enhance their profitability and increase their intrinsic value. Lowering the cost of capital allows businesses to undertake projects with higher expected returns, leading to value creation for shareholders. 9.2.4.2 Financial flexibility. Maintaining an optimal capital structure provides businesses with financial flexibility. Having access to both debt and equity financing options allows companies to adapt to changing market conditions and seize growth opportunities. This flexibility enables businesses to invest in research and development, expand operations, or pursue strategic acquisitions, all of which can contribute to increasing intrinsic value. 9.2.4.3 Risk management. An optimal capital structure helps businesses manage financial risk effectively. By balancing debt and equity, companies can mitigate the risk of financial distress and bankruptcy. A well-diversified capital structure reduces the reliance on a single source of financing and provides a cushion during economic downturns. This risk management approach enhances the stability and resilience of the business, ultimately contributing to higher intrinsic value. Conclusion. Optimizing the capital structure is a critical aspect of maximizing intrinsic value for businesses. By carefully considering factors such as business risk, cost of capital, growth opportunities, and industry norms, companies can determine the optimal mix of debt and equity financing. Achieving the right balance allows businesses to reduce the cost of capital, enhance financial flexibility, and effectively manage risk. Ultimately, an optimal capital structure contributes to the long-term success and value creation of the business. 9.3 Leverage and its influence on intrinsic value. Leverage, in the context of finance, refers to the use of borrowed funds to finance investments or operations. It involves utilizing debt to increase the potential returns of an investment. Leverage can have a significant impact on the intrinsic value of a business, as it affects both the cost of capital and the risk profile of the company. 9.3.1 Understanding leverage. Leverage can be categorized into two types: financial leverage and operating leverage. Financial leverage refers to the use of debt financing, such as loans or bonds, to fund a company's activities. Operating leverage, on the other hand, relates to the fixed costs of a business, which can magnify the impact of changes in revenue on the company's profitability. When a company takes on debt, it increases its leverage ratio, which is the proportion of debt to equity in its capital structure. This ratio indicates the extent to which a company relies on borrowed funds to finance its operations. A higher leverage ratio means that a larger portion of the company's capital is funded by debt, which can have implications for the company's intrinsic value. 9.3.2 Impact of leverage on intrinsic value. Leverage can influence the intrinsic value of a business in several ways. Firstly, it affects the cost of capital. When a company takes on debt, it incurs interest expenses that need to be paid to lenders. These interest expenses increase the company's cost of capital, as it needs to generate higher returns to cover the additional financial obligations. As a result, the intrinsic value of the business may be reduced, as the company's profitability is impacted by the higher cost of capital. Secondly, leverage can affect the risk profile of a company. By taking on debt, a company increases its financial risk, as it becomes more vulnerable to changes in interest rates and economic conditions. Higher levels of debt can also lead to increased financial distress, especially if the company is unable to meet its debt obligations. These risks can negatively impact the intrinsic value of the business, as investors may demand a higher return to compensate for the increased risk. Furthermore, leverage can influence the growth prospects of a company. While debt can provide a company with the necessary funds to invest in growth opportunities, excessive leverage can limit the company's ability to pursue such opportunities. High levels of debt may restrict a company's financial flexibility, making it more difficult to invest in research and development, expand into new markets, or acquire other businesses. This can hinder the company's long-term growth potential and, consequently, its intrinsic value. 9.3.3 Evaluating leverage and intrinsic value analysis. When assessing the impact of leverage on the intrinsic value of a business, it is important to consider both the benefits and risks associated with leverage. On one hand, leverage can amplify returns and enhance the value of a business if managed effectively. By using debt financing, a company can leverage its equity and generate higher returns on investment. This can increase the intrinsic value of the business, as the company's profitability is enhanced. On the other hand, excessive leverage can pose significant risks to the intrinsic value of a business. If a company becomes overleveraged, it may struggle to meet its debt obligations, leading to financial distress and potential bankruptcy. This can result in a significant decline in the intrinsic value of the business, as investors may lose confidence in the company's ability to generate future cash flows. To evaluate the impact of leverage on intrinsic value, analysts often use financial ratios such as the debt-to-equity ratio, interest coverage ratio, and debt service coverage ratio. These ratios provide insights into a company's leverage position and its ability to meet its debt obligations. By analyzing these ratios in conjunction with other financial metrics, investors can assess the level of risk associated with a company's leverage and its potential impact on intrinsic value. 9.3.4 Managing leverage for optimal intrinsic value. Managing leverage is crucial for maximizing the intrinsic value of a business. It requires a careful balance between utilizing debt to enhance returns and maintaining a sustainable level of financial risk. Here are some strategies that businesses can employ to manage leverage effectively. Debt capacity analysis. Conduct a thorough analysis of the company's debt capacity to determine the optimal level of leverage. This analysis should consider factors such as the company's cash flow generation, ability to service debt, and risk tolerance. Diversification of funding sources. Instead of relying solely on debt financing, businesses can explore alternative sources of funding, such as equity financing or strategic partnerships. Diversifying funding sources can reduce reliance on debt and mitigate the risks associated with leverage. Regular monitoring and refinancing. Continuously monitor the company's leverage position and regularly assess the cost in terms of existing debt. Refinancing existing debt at favorable rates can help optimize the company's capital structure and reduce the cost of capital. Maintaining a strong balance sheet. A strong balance sheet with healthy liquidity and manageable debt levels can enhance the company's ability to weather economic downturns and seize growth opportunities. By maintaining financial flexibility, businesses can better manage the risks associated with leverage. Effective risk management. Implement robust risk management practices to mitigate the potential negative impacts of leverage. This includes monitoring interest rate risk, currency risk, and other factors that can affect the company's ability to meet its debt obligations. By adopting these strategies, businesses can strike a balance between leveraging their operations to enhance returns and maintaining a sustainable level of financial risk. This can ultimately contribute to maximizing the intrinsic value of the business. In conclusion, leverage plays a significant role in determining the intrinsic value of a business. It affects the cost of capital, the risk profile of the company, and its growth prospects. While leverage can amplify returns and enhance the value of a business, excessive leverage can pose significant risks. Therefore, it is crucial for businesses to manage leverage effectively by carefully evaluating their debt capacity, diversifying funding sources, and maintaining a strong balance sheet. By doing so, businesses can optimize their intrinsic value and enhance their long-term sustainability. 9.4 Intrinsic value and cost of capital. The intrinsic value of a business is a fundamental concept in finance that represents the true worth of a company. It is the estimated value of a business based on its underlying assets, cash flows, and potential for future growth. Determining the intrinsic value is crucial for investors and decision makers as it helps them assess whether a business is overvalued or undervalued in the market. Intrinsic value is closely related to the cost of capital, which is the required rate of return that investors expect to receive for investing in a particular business. The cost of capital is influenced by various factors, including the risk associated with the investment, prevailing interest rates, and the company's capital structure. 9.4.1 Understanding the cost of capital. The cost of capital is the minimum return that a company must generate to satisfy its investors and lenders. It represents the opportunity cost of investing in a particular business rather than in alternative investments with similar risk profiles. The cost of capital is composed of two main components, the cost of debt and the cost of equity. The cost of debt is the interest rate that a company pays on its debt obligations. It is influenced by factors such as the company's creditworthiness, prevailing interest rates, and the terms of the debt agreement. The cost of debt is relatively easier to determine as it is based on observable market rates. On the other hand, the cost of equity represents the return that shareholders expect to receive for investing in a company's stock. It is influenced by factors such as the company's financial performance, growth prospects, and the overall riskiness of the stock market. Estimating the cost of equity is more challenging as it requires making assumptions and using financial models. 9.4.2 Estimating the cost of debt. The cost of debt can be estimated by analyzing the interest rates on the company's existing debt or by comparing the company's credit rating to the yields on similar rated bonds in the market. The cost of debt is typically lower than the cost of equity as debt holders have a higher priority claim on the company's assets and cash flows. To calculate the after-tax cost of debt, the tax shield provided by the deductibility of interest expenses should be considered. By deducting the tax shield from the pre-tax cost of debt, the after-tax cost of debt can be determined. This adjustment reflects the tax advantages associated with debt financing. 9.4.3 Estimating the cost of equity. The cost of equity is more subjective and requires the use of financial models such as the Capital Asset Pricing Model, CAPM, or the Dividend Discount Model, DDM. These models take into account the risk-free rate of return, the company's beta, a measure of systematic risk, and the equity risk premium. The risk-free rate of return is the return on an investment with no risk, typically represented by the yield on government bonds. The company's beta measures its sensitivity to market movements and is used to estimate the systematic risk associated with the company's stock. The equity risk premium represents the additional return that investors demand for investing in stocks rather than risk-free assets. 9.4.4 Weighted Average Cost of Capital, WACC. The weighted average cost of capital, WACC, is a financial metric that combines the cost of debt and the cost of equity to determine the overall cost of capital for a company. It represents the average rate of return that a company needs to generate to satisfy all of its investors. The WACC is calculated by weighting the cost of debt and the cost of equity based on their respective proportions in the company's capital structure. The weights are determined by the market value of the company's debt and equity. By multiplying the cost of debt by the weight of debt and the cost of equity by the weight of equity, and summing these values, the WACC can be calculated. The WACC is used as a discount rate in financial models such as the discounted cash flow (DCF) analysis to determine the present value of a company's future cash flows. It is also used as a benchmark for evaluating investment opportunities and making capital allocation decisions. 9.4.5 Impact of intrinsic value on cost of capital. The intrinsic value of a business has a direct impact on its cost of capital. If the market price of a company's stock is below its intrinsic value, the cost of equity will be higher as investors will demand a higher return to compensate for the perceived undervaluation. Conversely, if the market price is above the intrinsic value, the cost of equity will be lower as investors may be willing to accept a lower return due to the perceived overvaluation. Similarly, the cost of debt is influenced by the company's intrinsic value. If a company is perceived to have a higher intrinsic value, it may be able to negotiate lower interest rates on its debt, resulting in a lower cost of debt. Conversely, if the company's intrinsic value is lower, lenders may require higher interest rates to compensate for the perceived higher risk. In conclusion, the intrinsic value of a business and its cost of capital are closely intertwined. The intrinsic value provides a benchmark for assessing the true worth of a company, while the cost of capital represents the minimum return that investors expect to receive. By understanding the relationship between intrinsic value and cost of capital, investors and decision-makers can make more informed investment decisions and allocate capital efficiently. 10. Intrinsic value and mergers and acquisitions. 10.1 Intrinsic value assessment in M&A transactions. In mergers and acquisitions (M&A) transactions, assessing the intrinsic value of a business is crucial for making informed decisions and ensuring a successful outcome. The intrinsic value represents the true worth of a business, taking into account its underlying assets, cash flows, growth prospects, and other relevant factors. By understanding the intrinsic value, acquirers can determine whether a target company is undervalued or overvalued, and negotiate a fair price for the acquisition. 10.1.1 Importance of intrinsic value assessment in M&A. Assessing the intrinsic value of a target company is essential in M&A transactions for several reasons. Firstly, it helps the acquirer understand the potential synergies and benefits that can be derived from the acquisition. By evaluating the intrinsic value, the acquirer can identify areas where the target company's assets, capabilities, or market position can complement their own, leading to increased efficiency, market share, or profitability. Secondly, assessing the intrinsic value allows the acquirer to determine the fair price to pay for the target company. By comparing the intrinsic value with the proposed acquisition price, the acquirer can identify whether the deal is financially viable and offers a reasonable return on investment. This analysis helps prevent overpaying for the target company and ensures that the acquisition is value-enhancing for the acquirer's shareholders. Furthermore, understanding the intrinsic value of the target company provides insights into its long-term growth potential. By evaluating the target company's cash flows, market position, and competitive advantages, the acquirer can assess whether the acquisition aligns with their strategic objectives and contributes to sustainable growth. This assessment is crucial for making informed investment decisions and avoiding value-destructive acquisitions. 10.1.2 Methods for assessing intrinsic value in M&A. Several methods can be used to assess the intrinsic value of a target company in M&A transactions. These methods provide a framework for evaluating the financial and non-financial aspects of the target company and determining its true worth. Some commonly used methods include 10.1.2.1 Discounted cash flow (DCF) analysis. DCF analysis is a widely used method for assessing the intrinsic value of a business. It involves estimating the future cash flows generated by the target company and discounting them back to their present value using an appropriate discount rate. By considering the time value of money, DCF analysis provides a comprehensive view of the target company's value based on its expected future cash flows. 10.1.2.2 Comparable company analysis. Comparable company analysis involves comparing the target company's financial metrics, such as revenue, earnings, and valuation multiples, with those of similar companies in the industry. This method helps determine the relative value of the target company by benchmarking it against its peers. However, it is important to consider the differences in size, growth prospects, and other relevant factors when selecting comparable companies for analysis. 10.1.2.3 Asset-based valuation. Asset-based valuation involves assessing the value of the target company's underlying assets, such as property, plant, and equipment, inventory, and intellectual property. This method is particularly useful when the target company's assets are a significant driver of its value, such as in asset-heavy industries. However, it is important to consider the quality and marketability of the assets when determining their value. 10.1.2.4 Market valuation models. Market valuation models, such as the price-to-earnings P/E ratio or price-to-sales P/S ratio, can also be used to assess the intrinsic value of a target company. These models compare the target company's financial metrics with those of similar companies that are publicly traded. By applying the relevant valuation multiples, the acquirer can estimate the target company's value based on the market's perception of similar businesses. 10.1.3 Considerations in intrinsic value assessment for M&A. When assessing the intrinsic value of a target company in M&A transactions, it is important to consider several factors that can influence the valuation. These factors include 10.1.3.1 Synergies. Synergies play a crucial role in determining the intrinsic value of an acquisition. Synergies can arise from cost savings, revenue enhancements, or strategic advantages resulting from the combination of the acquirer and target company. It is important to evaluate the potential synergies and their impact on the intrinsic value to ensure that the acquisition is value-enhancing. 10.1.3.2 Market conditions. Market conditions can significantly impact the intrinsic value of a target company. Factors such as industry growth rates, competitive dynamics, and macroeconomic trends can influence the target company's future cash flows and growth prospects. It is important to consider these market conditions when assessing the intrinsic value to ensure realistic projections and avoid overestimating the target company's worth. 10.1.3.3 Integration risks. The successful integration of the target company into the acquirer's operations is crucial for realizing the expected synergies and value creation. Integration risks, such as cultural differences, operational challenges, and customer retention, can impact the intrinsic value of the acquisition. It is important to assess these risks and incorporate them into the intrinsic value assessment to ensure a realistic valuation. 10.1.3.4 Regulatory and legal considerations. Regulatory and legal considerations, such as antitrust regulations, intellectual property rights, and contractual obligations, can impact the intrinsic value of the target company. It is important to evaluate these considerations and their potential impact on the acquisition to ensure compliance and avoid any value-eroding legal issues. In conclusion, assessing the intrinsic value of a target company is crucial in M&A transactions to make informed decisions, determine a fair price, and identify potential synergies. Various methods, such as DCF analysis, comparable company analysis, asset-based valuation, and market valuation models, can be used to assess the intrinsic value. Additionally, considering factors such as synergies, market conditions, integration risks, and regulatory considerations is essential for a comprehensive intrinsic value assessment in M&A transactions. 10.2 Synergy analysis and its role in intrinsic value determination. Synergy analysis plays a crucial role in determining the intrinsic value of a business in the context of mergers and acquisitions (M&A). When two companies come together through a merger or acquisition, the combined entity has the potential to create value that is greater than the sum of its individual parts. This additional value is known as synergy, and it can significantly impact the intrinsic value of the merged entity. 10.2.1 Understanding synergy. Synergy refers to the concept of two or more entities working together to achieve a result that is greater than what they could have achieved individually. In the context of M&A, synergy can arise from various sources, such as cost savings, revenue enhancement, increased market power, and operational efficiencies. Cost savings can be achieved through economies of scale, where the merged entity can benefit from lower production costs, bulk purchasing discounts, or shared administrative expenses. By combining their resources, the companies can eliminate duplicate functions and streamline operations, leading to cost reductions. Revenue enhancement can result from cross-selling opportunities, where the merged entity can leverage its expanded customer base to offer a broader range of products or services. Additionally, the combined entity may have access to new markets or distribution channels, allowing for increased sales and revenue growth. Increased market power is another potential source of synergy. By merging, companies can strengthen their market position, negotiate better terms with suppliers or customers, and gain a competitive advantage over rivals. This enhanced market power can lead to increased profitability and higher intrinsic value. Operational efficiencies can be achieved by combining complementary capabilities and expertise. For example, one company may have strong research and development capabilities, while the other excels in manufacturing and distribution. By merging, the companies can leverage their respective strengths to create a more efficient and innovative organization. 10.2.2 Evaluating synergy. Assessing the potential synergy in an M&A transaction is a complex task that requires careful analysis and evaluation. The valuation of synergy involves estimating the incremental cash flows that the merged entity is expected to generate compared to the standalone entities. These cash flows are then discounted to their present value to determine their impact on the intrinsic value of the merged entity. There are several methods used to evaluate synergy, including qualitative assessments, financial modeling, and benchmarking against industry standards. Qualitative assessments involve analyzing the strategic fit between the merging companies, their cultural compatibility, and the potential for collaboration and innovation. Financial modeling involves projecting the future cash flows of the merged entity based on various assumptions and scenarios. Benchmarking against industry standards allows for a comparison of the expected performance of the merged entity with similar companies in the industry. It is important to note that synergy analysis is subject to uncertainties and risks. The actual realization of synergy may differ from the initial estimates due to factors such as integration challenges, cultural clashes, or unforeseen market conditions. Therefore, it is crucial to conduct thorough due diligence and consider conservative assumptions when evaluating synergy. 10.2.3 Impact on intrinsic value. Synergy analysis has a direct impact on the determination of the intrinsic value of the merged entity. The incremental cash flows generated by the synergy are incorporated into the discounted cash flow (DCF) analysis, which is one of the commonly used methods for valuing businesses. In the DCF analysis, the projected cash flows of the merged entity, including the synergistic effects, are estimated over a certain period of time. These cash flows are then discounted back to their present value using an appropriate discount rate, such as the weighted average cost of capital WACC. The present value of the cash flows represents the intrinsic value of the merged entity. If the synergy analysis indicates that the merged entity will generate significant incremental cash flows, the intrinsic value of the merged entity will be higher than the sum of the intrinsic values of the standalone entities. Conversely, if the synergy analysis suggests limited or negative synergies, the intrinsic value of the merged entity may be lower than the sum of the intrinsic values of the standalone entities. It is important to note that synergy analysis is just one component of the overall intrinsic value determination process. Other factors, such as the financial performance, market conditions, competitive landscape, and management capabilities, also influence the intrinsic value of a business. Therefore, synergy analysis should be considered in conjunction with other valuation techniques and factors to arrive at a comprehensive assessment of the intrinsic value of the merged entity. In conclusion, synergy analysis plays a crucial role in determining the intrinsic value of a business in the context of mergers and acquisitions. By assessing the potential synergies and incorporating them into the valuation process, investors and acquirers can make more informed decisions regarding the value and potential of the merged entity. However, it is important to conduct thorough due diligence and consider the uncertainties and risks associated with synergy analysis. 10.3 Valuation Methods for M&A and Intrinsic Value. In mergers and acquisitions (M&A) transactions, determining the intrinsic value of a business is crucial for making informed decisions and negotiating fair deals. Valuation methods play a significant role in assessing the intrinsic value of a target company and are essential tools for both buyers and sellers in the M&A process. 10.3.1 Comparable Company Analysis. One commonly used valuation method in M&A transactions is the comparable company analysis (CCA). This approach involves comparing the target company to similar publicly traded companies in the same industry. By analyzing key financial metrics such as price-to-earnings (PE) ratio, price-to-sales (PS) ratio, and price-to-book (PB) ratio, a valuation range can be established for the target company. The CCA method relies on the assumption that similar companies should have similar valuations. However, it is important to consider the differences in size, growth prospects, and financial performance between the target company and its comparables. Adjustments may need to be made to account for these variations and ensure a more accurate valuation. 10.3.2 Discounted Cash Flow Analysis. Another widely used valuation method in M&A transactions is the discounted cash flow (DCF) analysis. This approach estimates the intrinsic value of a business by calculating the present value of its expected future cash flows. The DCF analysis takes into account the time value of money, as it discounts future cash flows back to their present value using an appropriate discount rate. To perform a DCF analysis, the valuator needs to make assumptions about the target company's future cash flows, growth rates, and the appropriate discount rate. These assumptions are based on factors such as historical financial performance, industry trends, and market conditions. By discounting the projected cash flows, the DCF analysis provides an estimate of the target company's intrinsic value. 10.3.3 Asset-Based Valuation. Asset-based valuation methods focus on the value of a company's tangible and intangible assets. These methods are particularly useful when the target company has significant tangible assets, such as real estate or machinery, that can be easily valued. One common asset-based valuation method is the Adjusted Net Asset Value (ANAV) approach. This method calculates the value of a company by subtracting its liabilities from the fair market value of its assets. Adjustments may be made to account for factors such as depreciation, obsolescence, and intangible assets that are not reflected on the balance sheet. Asset-based valuation methods are often used as a complement to other valuation methods, providing a floor value for the target company. However, it is important to note that these methods may not capture the full value of intangible assets such as intellectual property, brand value, or customer relationships, which can be significant drivers of a company's intrinsic value. 10.3.4 Earnings Multiples. Earnings multiples, such as the price-to-earnings (PE) ratio, are commonly used in M&A transactions to assess the intrinsic value of a target company. These multiples compare the company's earnings to its market value or enterprise value, providing a measure of how the market values the company's earnings. The P/E ratio, for example, compares the company's stock price to its earnings per share (EPS). A higher P/E ratio indicates that the market values the company's earnings more highly, suggesting a higher intrinsic value. However, it is important to consider other factors such as growth prospects, industry dynamics, and the company's competitive position when using earnings multiples for valuation. 10.3.5 Combination of valuation methods. In practice, valuations for M&A transactions often involve a combination of different valuation methods. This approach helps to mitigate the limitations of individual methods and provides a more comprehensive assessment of the target company's intrinsic value. By using multiple valuation methods, such as CCA, DCF analysis, asset-based valuation, and earnings multiples, valuations can be cross-validated and potential discrepancies can be identified. This comprehensive approach allows buyers and sellers to have a more informed understanding of the target company's intrinsic value and facilitates more effective negotiations in M&A transactions. In conclusion, valuation methods play a crucial role in determining the intrinsic value of a business in M&A transactions. Comparable company analysis, discounted cash flow analysis, asset-based valuation, and earnings multiples are some of the commonly used methods. By combining these methods, buyers and sellers can gain a more comprehensive understanding of the target company's intrinsic value, enabling them to make informed decisions and negotiate fair deals in the M&A process. 10.4 Intrinsic value and post-merger integration. After a merger or acquisition, the focus of the newly formed entity shifts towards integrating the two organizations and maximizing the synergies that led to the merger in the first place. However, it is crucial to consider the impact of the merger on the intrinsic value of the business. Intrinsic value represents the true worth of a company, taking into account its underlying assets, cash flows, growth prospects, and other factors. Understanding how the merger affects the intrinsic value is essential for making informed decisions and ensuring the long-term success of the combined entity. 10.4.1 Assessing the impact on intrinsic value. When two companies merge, their intrinsic values may be affected in various ways. It is important to evaluate these changes to determine the overall impact on the combined entity. Here are some key considerations. Synergy analysis. One of the primary drivers behind mergers is the potential for synergies. Synergies can arise from cost savings, revenue enhancements, or a combination of both. It is crucial to assess the expected synergies and their impact on the intrinsic value of the merged entity. By identifying and quantifying these synergies, management can determine if the merger will result in an increase in the intrinsic value. Changes in cash flows. Mergers can lead to changes in the cash flows of the combined entity. This can be due to increased revenue opportunities, cost savings, or changes in the market dynamics. It is important to evaluate the impact of these changes on the intrinsic value. By analyzing the projected cash flows of the merged entity, management can assess whether the merger will result in an improvement or deterioration of the intrinsic value. Integration challenges. Post-merger integration is a complex process that can present various challenges. These challenges can range from cultural differences to operational inefficiencies. It is crucial to evaluate the potential impact of these integration challenges on the intrinsic value. By addressing these challenges effectively, management can mitigate any negative impact on the intrinsic value and ensure a smooth transition. 10.4.2 Strategies for maximizing intrinsic value. To maximize the intrinsic value of the merged entity, management should consider implementing the following strategies. Integration planning. Effective integration planning is crucial for maximizing the intrinsic value post-merger. This involves developing a comprehensive integration strategy that addresses key areas such as organizational structure, systems integration, and cultural alignment. By carefully planning the integration process, management can ensure a seamless transition and minimize any disruptions that could negatively impact the intrinsic value. Leveraging synergies. Identifying and leveraging synergies is essential for maximizing the intrinsic value. This involves aligning the operations of the merged entities to capture cost savings, revenue enhancements, and other synergistic benefits. By effectively integrating the operations and leveraging synergies, management can enhance the intrinsic value of the combined entity. Retaining key talent. During a merger, it is crucial to retain key talent from both organizations. Losing key employees can result in a loss of expertise and potential disruptions to the business. By implementing retention strategies and providing incentives for key employees, management can ensure the retention of valuable talent, which can positively impact the intrinsic value. Communication and stakeholder management. Effective communication and stakeholder management are vital for maintaining investor confidence and preserving the intrinsic value. It is important to communicate the benefits of the merger to shareholders, employees, customers, and other stakeholders. By addressing any concerns and providing transparent information, management can build trust and enhance the perception of the intrinsic value. 10.4.3 Monitoring and adjusting. After the merger, it is crucial to continuously monitor the performance of the combined entity and make necessary adjustments to maximize the intrinsic value. This involves regularly evaluating the financial performance, market dynamics, and operational efficiency of the merged organization. By monitoring key metrics and making data-driven decisions, management can identify areas for improvement and take proactive measures to enhance the intrinsic value. In conclusion, post-merger integration plays a significant role in determining the intrinsic value of the combined entity. By assessing the impact of the merger on the intrinsic value, implementing strategies to maximize value, and continuously monitoring and adjusting, management can ensure the long-term success and growth of the merged organization. Understanding the relationship between intrinsic value and post-merger integration is essential for making informed decisions and creating value for shareholders and stakeholders. 11. Intrinsic value and investor relations. 11.1 Communicating intrinsic value to shareholders and investors. Communicating the intrinsic value of a business to shareholders and investors is crucial for building trust, attracting investment, and ensuring the long-term success of the company. Intrinsic value represents the true worth of a business, taking into account its underlying assets, cash flows, growth potential, and other factors. Effectively conveying this value to stakeholders requires clear and transparent communication strategies. 11.1.1 The importance of communicating intrinsic value. When it comes to attracting investors and shareholders, the ability to effectively communicate the intrinsic value of a business is paramount. Investors want to understand the true worth of a company before committing their capital, and shareholders need to have confidence in the long-term prospects of the business. By clearly articulating the intrinsic value, companies can foster trust, enhance transparency, and attract the right investors who align with their strategic goals. 11.1.2 Tailoring the message. Communicating intrinsic value requires tailoring the message to different audiences. Shareholders and investors have varying levels of financial knowledge and understanding. Therefore, it is essential to present the information in a way that is easily comprehensible and relatable to each group. This can be achieved by using clear language, avoiding jargon, and providing relevant examples and comparisons. For shareholders, it is important to emphasize the long-term value of the business and how it aligns with their investment objectives. This can be done through regular updates, such as annual reports, shareholder meetings, and investor presentations. By highlighting the company's financial performance, growth prospects, and competitive advantages, shareholders can gain a deeper understanding of the intrinsic value and feel confident in their investment. Investors, on the other hand, require more detailed and comprehensive information to make informed decisions. Companies can provide this through investor relations activities, such as analyst briefings, conference calls, and one-on-one meetings. By presenting financial statements, key performance indicators, and growth strategies, companies can demonstrate the intrinsic value and potential returns to potential investors. 11.1.3 Transparency and disclosure. Transparency is a fundamental aspect of communicating intrinsic value. Companies should provide accurate and timely information to shareholders and investors, ensuring that they have access to all relevant data needed to assess the intrinsic value. This includes financial statements, annual reports, regulatory filings, and other disclosures required by regulatory bodies. By being transparent, companies can build trust and credibility with their stakeholders. It demonstrates a commitment to open communication and allows shareholders and investors to make informed decisions based on reliable information. Transparency also helps to mitigate any potential concerns or doubts that may arise, fostering a positive perception of the company's intrinsic value. 11.1.4 Utilizing various communication channels. To effectively communicate intrinsic value, companies should utilize a variety of communication channels. This ensures that the message reaches a wider audience and caters to different preferences. Some common channels include annual reports. These comprehensive reports provide a detailed overview of the company's financial performance, strategic initiatives, and future prospects. They are an important tool for communicating the intrinsic value to shareholders and investors. Investor presentations. These presentations are typically used during investor meetings, conferences, or roadshows. They provide an opportunity to showcase the company's intrinsic value through visual aids, such as charts, graphs, and key performance indicators. Press releases. Companies can use press releases to announce significant events or milestones that impact the intrinsic value. This helps to keep shareholders and investors informed about the company's progress and achievements. Investor relations websites. Maintaining an investor relations website is essential for providing easy access to relevant information. Companies can use this platform to publish financial reports, presentations, press releases, and other important updates. Social media. Social media platforms, such as Twitter, LinkedIn, and YouTube, can be utilized to share key messages, updates, and insights related to the company's intrinsic value. This allows for real-time communication and engagement with shareholders and investors. 11.1.5 Engaging with shareholders and investors. Engaging with shareholders and investors is a crucial part of communicating intrinsic value. Companies should actively seek feedback, address concerns, and provide opportunities for dialogue. This can be done through regular shareholder meetings, investor conferences, and one-on-one interactions. By engaging with stakeholders, companies can gain valuable insights and perspectives, which can help refine their communication strategies and enhance the understanding of intrinsic value. It also demonstrates a commitment to shareholder and investor relations, fostering a positive relationship and long-term support. 11.1.6 Case studies and examples. To further illustrate the concept of intrinsic value, companies can provide case studies and examples that highlight successful investments and the resulting value creation. These real-life examples can help shareholders and investors understand how the company's intrinsic value has translated into tangible returns. By showcasing specific projects, acquisitions, or market expansions, companies can demonstrate their ability to generate value and create long-term wealth for shareholders and investors. This not only reinforces the intrinsic value but also instills confidence in the company's strategic decision-making process. 11.1.7 Continuous communication and updates. Communicating intrinsic value is an ongoing process that requires continuous communication and regular updates. Companies should provide timely information on financial performance, market trends, and strategic initiatives. This ensures that shareholders and investors are kept informed about any changes that may impact the intrinsic value. Regular communication also allows companies to address any concerns or questions that arise, providing clarity and reassurance to stakeholders. By maintaining open lines of communication, companies can build trust, strengthen relationships, and enhance the perception of intrinsic value. In conclusion, effectively communicating the intrinsic value of a business to shareholders and investors is essential for building trust, attracting investment, and ensuring long-term success. By tailoring the message, emphasizing transparency, utilizing various communication channels, engaging with stakeholders, providing case studies, and maintaining regular updates, companies can effectively convey the true worth of their business and foster confidence in their intrinsic value. 11.2 Transparency and its impact on intrinsic value perception. Transparency plays a crucial role in shaping the perception of a company's intrinsic value. It refers to the extent to which a company provides accurate and timely information about its operations, financials, and decision-making processes to its stakeholders, including shareholders, investors, and the general public. The level of transparency exhibited by a company can significantly influence how its intrinsic value is perceived by the market. 11.2.1 The importance of transparency. Transparency is essential for several reasons. Firstly, it fosters trust and confidence among stakeholders. When a company is transparent in its operations, it demonstrates a commitment to openness and honesty. This, in turn, enhances the credibility of the company and its management, leading to increased trust from investors and shareholders. When stakeholders trust a company, they are more likely to perceive its intrinsic value positively. Secondly, transparency allows stakeholders to make informed decisions. By providing accurate and comprehensive information, companies enable investors and shareholders to assess the company's financial health, growth prospects, and risk profile. This information is crucial for determining the intrinsic value of a company. When stakeholders have access to reliable information, they can make better informed investment decisions, which can positively impact the perception of a company's intrinsic value. Thirdly, transparency promotes accountability. When a company is transparent, it is more likely to be held accountable for its actions and decisions. This accountability can act as a deterrent against unethical practices and mismanagement. Investors and shareholders are more likely to invest in companies that are transparent and accountable, as they perceive them to have a higher intrinsic value. 11.2.2 Enhancing transparency. To enhance transparency and positively influence the perception of intrinsic value, companies can adopt several practices. 11.2.2.1 Clear and comprehensive financial reporting. Companies should provide clear and comprehensive financial reports that adhere to accounting standards and regulations. These reports should include detailed information about the company's financial performance, cash flows, assets, liabilities, and equity. By presenting accurate and transparent financial information, companies can instill confidence in their stakeholders and improve the perception of their intrinsic value. 11.2.2.2 Timely disclosure of material information. Companies should promptly disclose material information that may impact their intrinsic value. Material information includes significant events, such as mergers and acquisitions, changes in management, financial results, and regulatory developments. Timely disclosure ensures that stakeholders have access to relevant information when making investment decisions, thereby influencing their perception of a company's intrinsic value. 11.2.2.3 Open and accessible investor relations. Companies should maintain open and accessible investor relations programs. This includes regular communication with shareholders and investors through various channels, such as quarterly earnings calls, annual general meetings, and investor presentations. By actively engaging with stakeholders and addressing their concerns, companies can build trust and enhance the perception of their intrinsic value. 11.2.2.4 Ethical corporate governance practices. Companies should adopt and adhere to ethical corporate governance practices. This includes having independent and diverse boards of directors, establishing clear policies and procedures, and ensuring transparency in decision-making processes. Ethical corporate governance practices not only promote transparency but also contribute to the overall perception of a company's intrinsic value. 11.2.3 The impact of transparency on intrinsic value perception. Transparency has a direct impact on how a company's intrinsic value is perceived by the market. When a company is transparent, it is more likely to be seen as trustworthy, reliable, and accountable. This positive perception can lead to a higher valuation of the company's intrinsic value. Investors and shareholders are more likely to assign a higher intrinsic value to companies that are transparent in their operations and financial reporting. They perceive transparent companies as having lower risks, better growth prospects, and stronger governance practices. As a result, these companies may attract more investment and enjoy a higher market valuation. On the other hand, companies that lack transparency may face skepticism and distrust from stakeholders. Investors and shareholders may perceive such companies as having higher risks and potential for hidden issues. This negative perception can lead to a lower valuation of the company's intrinsic value and may deter potential investors. In conclusion, transparency plays a vital role in shaping the perception of a company's intrinsic value. By being transparent in their operations, financial reporting, and decision-making processes, companies can enhance trust, enable informed decision-making, and promote accountability. These factors positively influence the perception of a company's intrinsic value, leading to potential benefits such as increased investor confidence, higher market valuation, and improved access to capital. 11.3 Intrinsic value and investor confidence. Investor confidence plays a crucial role in the determination of intrinsic value in business. When investors have confidence in a company, they are more likely to perceive its intrinsic value positively and make investment decisions accordingly. In this section, we will explore the relationship between intrinsic value and investor confidence, and how it can impact the overall valuation of a business. 11.3.1 The importance of investor confidence. Investor confidence refers to the belief and trust that investors have in a company's ability to generate returns and create value over time. It is influenced by various factors, including the company's financial performance, management credibility, market reputation, and overall market conditions. When investors have confidence in a company, they are more willing to invest their capital, which can positively impact the company's intrinsic value. 11.3.2 Building investor confidence. Building investor confidence is a continuous process that requires a company to demonstrate transparency, accountability, and strong performance. Here are some key factors that can contribute to building investor confidence. 11.3.2.1 Transparent financial reporting. Transparent financial reporting is essential for building investor confidence. Companies should provide accurate and timely financial information that is easily understandable and accessible to investors. This includes regular financial statements, annual reports, and disclosures of material events that may impact the company's performance. 11.3.2.2 Effective communication. Effective communication with investors is crucial for building and maintaining their confidence. Companies should provide regular updates on their performance, strategic initiatives, and any material changes that may affect the company's intrinsic value. This can be done through investor presentations, conference calls, and investor relations websites. 11.3.2.3 Strong corporate governance. A robust corporate governance framework is essential for building investor confidence. Companies should have clear policies and procedures in place to ensure transparency, accountability, and ethical behavior. This includes having independent directors on the board, establishing effective internal controls, and conducting regular audits. 11.3.2.4 Consistent performance. Consistent financial performance is a key driver of investor confidence. Companies that consistently meet or exceed their financial targets are more likely to gain the trust and confidence of investors. This requires effective strategic planning, efficient operations, and a focus on long-term value creation. 11.3.3 Impact of investor confidence on intrinsic value. Investor confidence can have a significant impact on the determination of intrinsic value. When investors have confidence in a company, they are more likely to assign a higher value to its future cash flows and growth prospects. This can result in a higher valuation of the company's intrinsic value. On the other hand, when investor confidence is low, it can lead to a lower valuation of the company's intrinsic value. Investors may discount the company's future cash flows and growth prospects, resulting in a lower perceived intrinsic value. This can have a negative impact on the company's stock price and its ability to raise capital. 11.3.4 Maintaining investor confidence. Maintaining investor confidence is crucial for the long-term success of a business. Here are some strategies that companies can employ to maintain investor confidence. 11.3.4.1 Consistent performance and results. Consistently delivering strong financial performance and meeting or exceeding market expectations is essential for maintaining investor confidence. Companies should focus on achieving their financial targets, implementing effective risk management strategies, and adapting to changing market conditions. 11.3.4.2 Effective investor relations. Effective investor relations play a vital role in maintaining investor confidence. Companies should proactively engage with investors, respond to their inquiries and concerns, and provide regular updates on the company's performance and strategic initiatives. This can help build trust and foster long-term relationships with investors. 11.3.4.3 Proactive risk management. Proactive risk management is crucial for maintaining investor confidence. Companies should identify and mitigate potential risks that may impact their performance and communicate these risks to investors. This includes addressing environmental, social, and governance (ESG) risks, regulatory risks, and market risks. 11.3.4.4 Long-term value creation. Companies should focus on creating long-term value for their shareholders to maintain investor confidence. This involves developing and executing a clear and sustainable growth strategy, investing in research and development, and continuously improving operational efficiency. By demonstrating a commitment to long-term value creation, companies can enhance investor confidence in their intrinsic value. Conclusion. Investor confidence is a critical factor in the determination of intrinsic value in business. When investors have confidence in a company, they are more likely to perceive its intrinsic value positively, leading to a higher valuation. Building and maintaining investor confidence requires transparent financial reporting, effective communication, strong corporate governance, and consistent performance. By prioritizing investor confidence, companies can enhance their intrinsic value and attract long-term investors who believe in their growth potential. 11.4 Intrinsic value and stakeholder management. Stakeholder management is a crucial aspect of running a successful business. It involves identifying and understanding the needs, expectations, and interests of various stakeholders and developing strategies to effectively engage and communicate with them. Intrinsic value plays a significant role in stakeholder management as it provides a framework for assessing the long-term worth and potential of a business. 11.4.1 Understanding stakeholders. Stakeholders are individuals or groups who have a vested interest in the success and performance of a business. They can include shareholders, employees, customers, suppliers, creditors, government agencies, and the local community. Each stakeholder group has different expectations and concerns, and it is essential for businesses to identify and prioritize these stakeholders to effectively manage their relationships. 11.4.2 Importance of intrinsic value in stakeholder management. Intrinsic value provides a comprehensive assessment of a business's worth beyond its market price. It takes into account various factors such as financial performance, market position, competitive advantage, and growth potential. By understanding the intrinsic value of a business, stakeholders can make informed decisions and evaluate the long-term prospects of their involvement. For shareholders, intrinsic value is a critical measure of the worth of their investment. It helps them assess whether the current market price accurately reflects the true value of the business. By understanding the intrinsic value, shareholders can make informed decisions about buying, holding, or selling their shares. Employees are another important stakeholder group. Understanding the intrinsic value of a business helps employees gauge the stability and growth potential of their organization. It provides them with confidence in the company's long-term prospects and can influence their commitment, motivation, and job satisfaction. Customers also benefit from businesses that focus on intrinsic value. By understanding the worth and potential of a company, customers can assess the quality and reliability of its products or services. This knowledge helps them make informed purchasing decisions and build long-term relationships with businesses that align with their values and expectations. Suppliers and creditors also have a vested interest in the intrinsic value of a business. By understanding the worth and potential of their customers, suppliers can assess the stability and reliability of their business partners. Creditors, on the other hand, use intrinsic value to evaluate the creditworthiness and financial health of a business before extending credit or loans. Government agencies and the local community are also stakeholders with an interest in the intrinsic value of a business. Understanding the worth and potential of a company helps government agencies assess its contribution to the economy, job creation, and compliance with regulations. The local community benefits from businesses that create value and contribute to the overall well-being of the community. 11.4.3 Communicating intrinsic value to stakeholders. Effectively communicating the intrinsic value of a business to stakeholders is crucial for building trust, maintaining positive relationships, and managing expectations. Here are some strategies for communicating intrinsic value to different stakeholder groups. Shareholders. Provide regular updates on the financial performance and growth prospects of the business. Share detailed reports and analysis that highlight the intrinsic value of the company. Conduct investor meetings and conferences to discuss the long-term potential of the business. Engage with shareholders through newsletters, annual reports, and online platforms. Employees. Communicate the company's vision, mission, and long-term goals to employees. Provide regular updates on the financial performance and growth prospects of the business. Conduct town hall meetings and employee forums to address questions and concerns. Recognize and reward employees for their contributions to the company's intrinsic value. Customers. Clearly communicate the value proposition and unique selling points of the products or services. Provide transparent information about the company's financial stability and growth potential. Seek customer feedback and address concerns promptly and effectively. Build long-term relationships based on trust, reliability, and shared values. Suppliers and creditors. Share financial statements and reports that demonstrate the financial health and stability of the business. Communicate the company's commitment to timely payments and fair business practices. Establish open lines of communication to address any concerns or issues promptly. Provide regular updates on the company's growth plans and potential opportunities for suppliers. Government agencies and the local community. Engage with government agencies through regular communication and compliance with regulations. Share information about the company's contribution to the local economy, job creation, and community development. Participate in community initiatives and support local causes to demonstrate social responsibility. Foster open dialogue and collaboration with local stakeholders to address concerns and build positive relationships. By effectively communicating the intrinsic value of a business to stakeholders, organizations can build trust, enhance their reputation, and create a positive environment for long-term success. Stakeholder management becomes a strategic tool for businesses to align their interests with those of their stakeholders and create shared value. 12. Future trends in intrinsic value analysis. 12.1 Technological advancements and their influence on intrinsic value. Technology has become an integral part of our lives, transforming the way we live, work, and do business. In the realm of business, technological advancements have had a profound impact on various aspects, including the determination of intrinsic value. In this section, we will explore how technological advancements influence intrinsic value and the implications for businesses. 12.1.1 Automation and efficiency. One of the key ways in which technology influences intrinsic value is through automation and increased efficiency. Automation allows businesses to streamline their operations, reduce costs, and improve productivity. By replacing manual processes with automated systems, businesses can achieve higher levels of efficiency, which directly impacts their intrinsic value. For example, the implementation of advanced manufacturing technologies, such as robotics and artificial intelligence, can significantly enhance production processes. These technologies can improve accuracy, reduce errors, and increase output, leading to higher profitability and ultimately, a higher intrinsic value. 12.1.2 Data analytics and decision-making. Technological advancements have also revolutionized the way businesses collect, analyze, and utilize data. With the advent of big data analytics, businesses can now gather and process vast amounts of information to gain valuable insights into consumer behavior, market trends, and operational performance. By leveraging data analytics, businesses can make more informed decisions, identify growth opportunities, and mitigate risks. This ability to make data-driven decisions enhances the intrinsic value of a business by increasing its ability to adapt to changing market conditions and capitalize on emerging trends. 12.1.3 Digital transformation and market reach. The digital revolution has opened up new avenues for businesses to expand their market reach and customer base. Through the internet and digital platforms, businesses can now connect with customers globally, breaking down geographical barriers and reaching a wider audience. Digital transformation not only increases a business's potential market size but also enables more efficient and targeted marketing strategies. By leveraging digital marketing techniques, businesses can reach their target audience more effectively, resulting in higher customer acquisition and retention rates. This increased market reach and customer engagement contribute to the intrinsic value of a business. 12.1.4 Innovation and competitive advantage. Technological advancements foster innovation, which plays a crucial role in determining a business's intrinsic value. Businesses that embrace innovation and stay at the forefront of technological developments gain a competitive advantage over their peers. Innovation can take various forms, such as the development of new products or services, the implementation of cutting-edge technologies, or the creation of disruptive business models. These innovations not only differentiate a business from its competitors but also enhance its intrinsic value by positioning it as a leader in its industry. 12.1.5 Customer experience and brand value. Technology has transformed the way businesses interact with their customers, leading to enhanced customer experiences. Through the use of digital platforms, businesses can provide personalized and seamless experiences, catering to the unique needs and preferences of their customers. A positive customer experience not only fosters customer loyalty but also enhances a business's brand value. A strong brand reputation contributes to the intrinsic value of a business by increasing customer trust, attracting new customers, and commanding premium pricing. 12.1.6 Cybersecurity and risk mitigation. As businesses become increasingly reliant on technology, the importance of cybersecurity cannot be overstated. Technological advancements have brought about new risks and vulnerabilities, such as data breaches and cyber attacks. The ability to effectively manage these risks is crucial for preserving the intrinsic value of a business. Investing in robust cybersecurity measures not only protects a business's assets and sensitive information but also safeguards its reputation and customer trust. By mitigating cybersecurity risks, businesses can maintain their intrinsic value by avoiding costly security breaches and the associated financial and reputational damages. 12.1.7 Adaptability and future growth. Technological advancements have accelerated the pace of change in the business landscape. Businesses that can adapt and embrace new technologies are better positioned for future growth and sustainability. The ability to anticipate and respond to technological disruptions is essential for maintaining and increasing intrinsic value. By staying ahead of the curve and continuously innovating, businesses can seize new opportunities and navigate through challenges. This adaptability and future growth potential contribute to the intrinsic value of a business by instilling confidence in investors and stakeholders. In conclusion, technological advancements have a significant influence on the intrinsic value of a business. From automation and efficiency gains to data analytics and decision-making capabilities, technology has transformed the way businesses operate and create value. Embracing technological advancements not only enhances a business's competitive advantage but also positions it for future growth and sustainability. Businesses that harness the power of technology and leverage it effectively are more likely to maximize their intrinsic value and thrive in the ever-evolving business landscape. 12.2 Environmental, social, and governance (ESG) factors and intrinsic value. In recent years, there has been a growing recognition of the importance of environmental, social, and governance (ESG) factors in assessing the intrinsic value of a business. ESG factors refer to the environmental, social, and governance practices and policies that a company adopts and how they impact its long-term sustainability and performance. These factors have gained significant attention from investors, regulators, and other stakeholders as they provide valuable insights into a company's risk profile, reputation, and ability to create long-term value. 12.2.1 Environmental factors and intrinsic value. Environmental factors encompass a wide range of issues, including a company's impact on climate change, natural resource usage, pollution, waste management, and energy efficiency. These factors are crucial in determining a company's environmental sustainability and its ability to adapt to changing environmental regulations and consumer preferences. From an intrinsic value perspective, companies that effectively manage their environmental impact are more likely to mitigate risks associated with regulatory compliance, reputational damage, and potential lawsuits. By incorporating sustainable practices, such as reducing greenhouse gas emissions, implementing renewable energy sources, and adopting eco-friendly manufacturing processes, companies can enhance their long-term value proposition and attract environmentally conscious investors. Furthermore, companies that proactively address environmental challenges are better positioned to capitalize on emerging opportunities in the green economy. As governments and consumers increasingly prioritize sustainability, businesses that align their operations with environmental goals can gain a competitive advantage and access new markets. 12.2.2 Social factors and intrinsic value. Social factors encompass a company's impact on society, including its relationships with employees, customers, suppliers, and local communities. These factors include labor practices, human rights, product safety, customer satisfaction, community engagement, and diversity and inclusion. Companies that prioritize social responsibility and maintain positive relationships with their stakeholders are more likely to enhance their intrinsic value. By fostering a positive work environment, ensuring fair labor practices, and promoting diversity and inclusion, companies can attract and retain top talent, improve employee productivity, and enhance their reputation. Moreover, companies that prioritize customer satisfaction and safety are more likely to build strong brand loyalty and customer trust, leading to increased sales and market share. By engaging with local communities and supporting social initiatives, companies can also enhance their reputation and strengthen their social license to operate. 12.2.3 Governance factors and intrinsic value. Governance factors refer to a company's internal controls, board structure, executive compensation, shareholder rights, and ethical standards. Effective governance practices are essential for ensuring transparency, accountability, and the protection of shareholder interests. From an intrinsic value perspective, companies with strong governance practices are more likely to attract investors and maintain their long-term sustainability. Transparent financial reporting, independent board oversight, and effective risk management systems inspire confidence among investors and reduce the likelihood of fraud or unethical behavior. Furthermore, companies with robust governance frameworks are better equipped to navigate complex business environments, make informed decisions, and respond to emerging risks and opportunities. By aligning executive compensation with long-term performance and shareholder value creation, companies can incentivize management to prioritize sustainable growth and value creation. 12.2.4 Integrating ESG factors into intrinsic value analysis. Integrating ESG factors into the analysis of intrinsic value requires a comprehensive and systematic approach. Investors and analysts can utilize various frameworks, such as the Sustainability Accounting Standards Board (SASB) standards, Global Reporting Initiative (GRI) guidelines, and the Task Force on Climate-Related Financial Disclosures (TCFD) recommendations, to assess a company's ESG performance and its impact on intrinsic value. By incorporating ESG factors into financial models and valuation techniques, investors can gain a more holistic view of a company's risk profile, growth potential, and long-term value creation. This integrated approach allows investors to identify companies that are better positioned to navigate ESG-related risks and capitalize on emerging opportunities. Furthermore, the integration of ESG factors into investment decision-making promotes responsible investing and encourages companies to adopt sustainable practices. As more investors prioritize ESG considerations, companies that fail to address these factors may face increased scrutiny, reputational damage, and a higher cost of capital. Conclusion. The consideration of environmental, social, and governance (ESG) factors in assessing the intrinsic value of a business has become increasingly important. Environmental factors, such as climate change and resource usage, social factors, including labor practices and community engagement, and governance factors, such as transparency and accountability, all play a significant role in determining a company's long-term sustainability and value creation potential. Integrating ESG factors into intrinsic value analysis allows investors to gain a more comprehensive understanding of a company's risk profile, growth potential, and ability to create long-term value. By considering these factors, investors can make more informed investment decisions, promote responsible investing practices, and encourage companies to adopt sustainable business practices. Ultimately, the integration of ESG factors into intrinsic value analysis contributes to a more sustainable and resilient global economy. 12.3 Intrinsic value in the digital age. In today's rapidly evolving digital age, the concept of intrinsic value has taken on a whole new dimension. As technology continues to reshape industries and disrupt traditional business models, understanding and assessing intrinsic value has become more crucial than ever before. The digital age has brought about significant changes in the way businesses operate, communicate, and create value. In this section, we will explore how intrinsic value is influenced by the digital transformation and the unique challenges and opportunities it presents. 12.3.1 The impact of technology on intrinsic value. Technology has revolutionized the way businesses operate, enabling them to streamline processes, enhance efficiency, and reach a wider audience. The digital age has given rise to new business models, such as e-commerce platforms, software-as-a-service (SaaS) companies, and digital marketplaces, which have disrupted traditional industries and created new opportunities for value creation. One of the key ways technology impacts intrinsic value is through the creation of intangible assets. In the digital age, intellectual property, brand value, and customer relationships have become increasingly important drivers of intrinsic value. Companies that can leverage technology to develop innovative products, build strong brands, and cultivate customer loyalty are better positioned to create long-term value. Furthermore, technology has also enabled businesses to collect and analyze vast amounts of data, providing valuable insights into customer behavior, market trends, and operational performance. This data-driven approach allows companies to make more informed decisions, optimize processes, and identify new growth opportunities, ultimately enhancing their intrinsic value. 12.3.2 Digital disruption and intrinsic value. The digital age has also brought about significant disruption, challenging traditional business models and reshaping entire industries. Companies that fail to adapt to these disruptions risk losing their competitive advantage and seeing a decline in their intrinsic value. Digital disruption can occur in various forms, such as the emergence of new technologies, changing consumer preferences, or the entry of innovative startups. Established companies must embrace digital transformation to stay relevant and maintain their intrinsic value. This may involve investing in new technologies, reimagining business processes, and fostering a culture of innovation. On the other hand, digital disruption also presents opportunities for businesses to create value and enhance their intrinsic value. By embracing new technologies and leveraging digital platforms, companies can reach a global audience, expand their market share, and create new revenue streams. Successful digital disruptors, such as Amazon, Netflix, and Uber, have demonstrated how embracing technology can lead to exponential growth and increased intrinsic value. 12.3.3 The importance of digital strategy in assessing intrinsic value. In the digital age, having a well-defined digital strategy is essential for assessing and maximizing intrinsic value. A digital strategy encompasses the use of technology to achieve business objectives, enhance customer experience, and drive value creation. It involves aligning technology initiatives with overall business goals and ensuring that digital investments contribute to long-term intrinsic value. A robust digital strategy should consider various factors, including market trends, customer preferences, competitive landscape, and technological advancements. It should outline how technology will be leveraged to improve operational efficiency, enhance customer engagement, and drive innovation. By aligning digital initiatives with intrinsic value drivers, companies can ensure that their digital investments generate a positive return and contribute to long-term value creation. Furthermore, a digital strategy should also address potential risks and challenges associated with technology adoption. These may include cybersecurity threats, data privacy concerns, and the need for ongoing technological upgrades. By proactively addressing these risks, companies can safeguard their intrinsic value and maintain the trust of stakeholders. 12.3.4 Harnessing the power of digital platforms for intrinsic value. Digital platforms have emerged as powerful tools for value creation in the digital age. These platforms enable businesses to connect with customers, partners, and suppliers in new and innovative ways, facilitating collaboration, knowledge sharing, and value exchange. Companies that can effectively leverage digital platforms can enhance their intrinsic value by expanding their reach, accessing new markets, and driving customer engagement. For example, social media platforms provide businesses with an opportunity to build brand awareness, engage with customers, and gather valuable feedback. E-commerce platforms enable companies to sell products globally, reaching a larger customer base and increasing revenue potential. However, harnessing the power of digital platforms requires a deep understanding of the platform's dynamics, user behavior, and competitive landscape. Companies must develop strategies to differentiate themselves, provide unique value propositions, and build strong relationships with platform users. By effectively leveraging digital platforms, businesses can enhance their intrinsic value and gain a competitive edge in the digital age. 12.3.5 The role of innovation in driving intrinsic value in the digital age. Innovation has always been a key driver of intrinsic value, and in the digital age, it has become even more critical. Technology has opened up new possibilities for innovation, enabling businesses to develop groundbreaking products, services, and business models. Companies that prioritize innovation and invest in research and development are better positioned to create value and maintain their intrinsic value in the digital age. Innovation can take various forms, including product innovation, process innovation, business model innovation, and customer experience innovation. By continuously pushing the boundaries of what is possible, companies can stay ahead of the competition and drive long-term intrinsic value growth. Furthermore, the digital age has also given rise to open innovation, where companies collaborate with external partners, such as startups, universities, and research institutions, to drive innovation. By tapping into external expertise and resources, companies can accelerate the pace of innovation, reduce costs, and mitigate risks. Open innovation can be a powerful strategy for enhancing intrinsic value in the digital age. In conclusion, the digital age has brought about significant changes in the way businesses operate and create value. Understanding and assessing intrinsic value in this digital landscape is crucial for businesses to thrive and maintain their competitive advantage. By embracing technology, developing a robust digital strategy, harnessing the power of digital platforms, and fostering a culture of innovation, companies can enhance their intrinsic value and seize the opportunities presented by the digital age. 12.4 Emerging Markets and Intrinsic Value Opportunities. Emerging markets have become a significant focus for investors seeking new opportunities and higher returns. These markets, characterized by rapid economic growth and increasing levels of industrialization, offer unique prospects for businesses and investors alike. In this section, we will explore the concept of intrinsic value in the context of emerging markets and discuss the opportunities it presents. 12.4.1 Understanding emerging markets. Emerging markets, also known as developing economies, are countries that are experiencing rapid economic growth and industrialization. These markets often have lower per capita income levels compared to developed countries but are characterized by a high potential for growth. Examples of emerging markets include countries like China, India, Brazil, Russia, and many others. The allure of emerging markets lies in their potential for high returns on investment. As these economies grow, they offer opportunities for businesses to expand their operations and tap into new consumer markets. However, investing in emerging markets also comes with its own set of challenges and risks. 12.4.2 Intrinsic Value in Emerging Markets. Intrinsic value remains a crucial concept when evaluating investment opportunities in emerging markets. It represents the true worth of a business or asset, independent of its market price. Assessing intrinsic value requires a thorough analysis of various factors, including financial performance, market conditions, and growth prospects. In emerging markets, intrinsic value analysis becomes even more critical due to the higher levels of uncertainty and volatility. These markets often experience rapid changes in economic and political conditions, which can significantly impact the value of businesses operating within them. Therefore, understanding the intrinsic value of a business becomes essential for making informed investment decisions. 12.4.3 Factors affecting intrinsic value in emerging markets. Several factors influence the intrinsic value of businesses in emerging markets. Let's explore some of the key factors. Economic growth and market potential. Emerging markets are known for their high economic growth rates. As these economies expand, they create new opportunities for businesses to thrive. The potential market size and demand for products or services play a crucial role in determining the intrinsic value of a business. Investors need to assess the growth potential of the market and the company's ability to capture a significant share of it. Political and regulatory environment. The political and regulatory environment in emerging markets can significantly impact the intrinsic value of businesses. Political stability, government policies, and regulations can either support or hinder business operations. Investors must evaluate the political and regulatory risks associated with investing in a particular market and assess their potential impact on the intrinsic value of a business. Currency and exchange rate risks. Emerging markets often have volatile currencies and exchange rates. Fluctuations in currency values can impact the profitability and competitiveness of businesses operating in these markets. Investors need to consider the currency and exchange rate risks when assessing the intrinsic value of a business in an emerging market. Infrastructure and logistics. The quality of infrastructure and logistics networks in emerging markets can affect the operational efficiency and cost structure of businesses. Inadequate infrastructure can lead to higher costs, delays, and inefficiencies. Investors should evaluate the infrastructure and logistics capabilities of a market to determine the intrinsic value of a business. Competitive landscape. The competitive landscape in emerging markets can be intense, with both local and international players vying for market share. Understanding the competitive dynamics and the company's competitive advantage is crucial for assessing its intrinsic value. Investors need to evaluate the company's positioning, differentiation, and ability to withstand competition in the market. 12.4.4 Seizing intrinsic value opportunities in emerging markets. Investing in emerging markets requires a comprehensive approach that considers both the opportunities and risks involved. Here are some strategies to seize intrinsic value opportunities in emerging markets. Thorough due diligence. Conducting thorough due diligence is essential when evaluating investment opportunities in emerging markets. This includes analyzing financial statements, assessing market conditions, understanding the competitive landscape, and evaluating the regulatory environment. A comprehensive due diligence process helps investors identify intrinsic value opportunities and mitigate potential risks. Long-term perspective. Investing in emerging markets often requires a long-term perspective. These markets can be volatile and subject to economic and political fluctuations. By adopting a long-term approach, investors can ride out short-term market volatility and capture the growth potential of emerging markets. Diversification. Diversification is a key risk management strategy when investing in emerging markets. By spreading investments across different countries, industries, and asset classes, investors can reduce their exposure to specific risks and increase their chances of capturing intrinsic value opportunities. Partnering with local experts. Partnering with local experts and advisors can provide valuable insights into the nuances of operating in emerging markets. Local expertise can help investors navigate the regulatory landscape, understand cultural differences, and identify attractive investment opportunities. Monitoring and adaptation. Investing in emerging markets requires continuous monitoring and adaptation. Market conditions can change rapidly, and investors need to stay informed and adjust their strategies accordingly. Regularly reassessing the intrinsic value of investments and making necessary adjustments is crucial for long-term success. Conclusion. Emerging markets offer exciting opportunities for businesses and investors. However, navigating these markets requires a deep understanding of intrinsic value and the factors that influence it. By conducting thorough analysis, considering the unique characteristics of emerging markets, and adopting appropriate strategies, investors can seize intrinsic value opportunities and achieve long-term success in these dynamic economies.